Check, check, check. What's up, everybody? How we doing?
Woo!
How we feeling?
Got a little energy in the room.
This is exciting. This is exciting. Look at all these awesome people.
We've got a lot of people online, too, that have come in virtually.
A couple thousand, I'm sure.
Yep. And we've got all of you here in person at the TIP Lightbox in Toronto and virtually from all over the world. So big round of applause. We're so happy to have you all here.
Let's go, yeah!
And it's our first ever Grit Money Summit. This is the first time we're putting this on, but not the last. My name is Genevieve Rockdector. I'm the founder of Grit, and with me today, my amazing co-host is Austin Hankwitz, who is the head analyst for Grit. And if you don't know Austin, well, you do now, but he has over 1 million followers on social media. He has a top 10 business podcast on Spotify globally. And he's building a $2 million portfolio, which he's sharing with all of you as Grit subscribers. You'd be learning about what he's buying, what he's selling, and he's doing that all open source on the internet, which is amazing. So what do we have in store here, Austin? What are we doing today?
We're going to have some fun. But before we talk about that, look at these people. We've got such an awesome crowd of analysts. We've got creators and founders and everyone from in between. It is so cool to see us all come together for this united goal of navigating the complex financial landscape that's happening right now in the stock market. And not just navigating it, but taking advantage of the opportunities that present themselves.
And some of you may know this, or some of you may not, but Grit itself started as a very simple, kind of accidental idea. Back in the midst of COVID in 2020, I started a newsletter in November. I had no idea what to do with my life. I had just shut down my previous business, as many business owners in the room would remember those times. And that simple one newsletter, which had a list of 5,000 subscribers from my previous company, started to just grow and grow, several hundred a week, then several thousand a week. And we got it up to 100,000 organically on Substack, and then we continue to grow and grow and grow, and then lo and behold, about 4 and a bit years later, we're 250,000 subscribers all around the world on one united mission, and that mission is to build a wealthy life. And we know that that's about your portfolio and your investments and your businesses, but as we will learn later today with our keynote speaker, Sahil Bloom, if you master 4 other pillars of wealth, so outside your financials, you could actually end up being richer than Warren Buffett. So we're really excited about that talk. Stay tuned.
That'll be a really fun one. But reflecting upon now 2024, my gosh, it was crazy. We had the rise of AI, we had falling interest rates, we had rising inflation, and I swear every week was a different headline that made me just look and say, what the heck did I just read? And that feeling has followed us into 2025. I mean, we've got President Trump who's now making me look at the markets and say, dang, is it really that red today?
Well, you know what they say, a calm sea never made for a skillful sailor. So we're being tested in 2025, and there's no better time than when you're being tested to come together and listen to experts who are managing their own money like Austin, or managing several hundreds of millions, if not billions for some of the speakers here, to find out what they're doing. What are they doing in the short term, medium term, and long term? Because in these times, you need some navigational help out there.
That's right. And now, before we dive into all the good stuff, because I'm so excited to hear from these incredible speakers, right? We have Sahil Bloom, we have Cody Sanchez, and Michelle Romano. Let's kick things off with a little bit of a hype video. I think you guys are going to like it. It really embodies the spirit of Grit and where we could be heading next. And a quick shout out to the voiceover actor in this video. You might recognize his voice. It's me.
All right, cue the video.
It's October 2022. The stock market is tanking as a ruthless bear market rips through our portfolios. The S&P 500 is down over 25% from its peak, and Jim Cramer is on Mad Money warning everyone that we're in a bear market and it's not over yet.
Owning most stocks is going to be an uphill battle. And if it's too hard for you, you should sell them.
Unfortunately, chaos is ruling our investing lives. But then, a spark. OpenAI reveals ChatGPT to the world for the first time in November of 2022, and AI is no longer a dream, it's real. It's here, and it's the spark we needed to ignite a rebound in the markets. Tech stocks are soaring, Nvidia skyrockets, and every company in the world is trying to figure out how to use this new technology for themselves. 2023 marks the best year for stocks since 1997. The Nasdaq skyrockets 55%, the S&P 500 climbs 24%, and everyone is getting excited again. And here comes 2024, another banger year for the stock market. Sure, the yen carry trade unraveled, jolting markets in a wild summer dip, but we bounce back tougher than ever. November 2024, Trump's election win triggers a melt-up in the markets, with the Dow and S&P 500 notching their best months of the year. Crypto is ablaze, Bitcoin seems unstoppable, and households are all in, with their own stock allocations hitting a record 49%, doubling since the great financial crisis. Investing is easier than ever, but it's become trickier too. 2025 is here, and it's been no walk in the park. With both the S&P 500 and the Nasdaq falling into correction territory in the month of March, it's never been more important to understand what's coming next. The Grit Money Summit is your edge. Through our acquisition of the Rate of Return newsletter and our merger with AM Notify, Grit and its 250,000 subscribers is supercharging the future of the DIY investor. Join us to master these wild markets, learn from experts, and own the chaos. Don't just keep up, lead. The future is now. Welcome to the Grit Money Summit.
Hey, that was kind of cool, huh? Yeah. That was awesome. Oh, no one walked behind me. That's okay. Come on out, y'all.
We're here.
Go. Here we are.
What's up, everybody?
Let's do it. Let's do it.
Yeah.
Oh. Maybe not. Want to use mine?
Check.
Can you hear me now?
There
Perfect. There we go. Well, thank you so much, Austin and Genevieve, for warming up the audience. This was awesome. And the video that was just shown, you said, you know, that we might recognize the voice. And if I had to take a wild guess, I think it was your voice.
It was my voice. Yeah, that was cool. Thanks, guys. I'm glad y'all liked it.
Wonderful. And so for today's session, I'm super excited to be kicking off the Grit Money Summit with our session. We have a topic that I believe can be quite impactful when it comes to wealth building. So the topic at bay today is the compounding of money, but in a tax-efficient way. And I have to say that to discuss this subject, we have a powerhouse of a panel. So let me introduce them to you. Of course, you know Austin already. So in terms of a bit of a more formal introduction, Austin is the head analyst at Grit, as well as the co-host of the Rich Habits podcast, which I must say is one of the top 10 business podcasts on Spotify with millions and millions of downloads. Congratulations on that.
Thank you so much.
And then next we have Robert Croak. Hi, Robert. Robert is the other co-host of the Rich Habits podcast. But in addition to that, Robert is a very successful entrepreneur and angel investor. And I don't know if you want me to mention this, but he is also the founder of Silly Bands, if any of you remember what they are. And Robert is wearing them, so I'm sure you get to see them on his wrist.
Yes. Behind the green band.
Wonderful. And we have Tom Bruni. Tom is editor-in-chief and VP of community at StockTwits. StockTwits is the largest social community connecting investors and traders, providing them with real-time content, information, and insights. Thank you very much, Tom, for being here.
Thanks for having me.
And I must mention that all three of you have traveled from the United States to be here with us today, so thank you so much. And I'm happy that you lucked out with the weather, because we had snow yesterday. And then online, we have our friends from Neos Investments. You can see them on the screen. Hi, Garrett. Hi, Troy. So,
hi, nice to meet you. Thanks for having us.
Yes, of course. So in terms of a bit of
everyone.
Hi. In terms of a bit of a more formal introduction for our friends online, we have Garrett Paolella, who is co-founder and managing partner at Neos Investments, which is a provider of ETFs. And Garrett is responsible for managing all of Neos Investments ETFs. And then we have Troy Cates, who is also co-founder and managing partner at Neos Investments. And Troy, I must say, is a pioneer when it comes to launching ETF. As for myself, I'm the moderator for today's session, Sarah Lorio. I'm an institutional portfolio manager at CI Global Asset Management here in Canada, and I'm also the host of CFA Society Toronto's Diverse Dividend Series. So with that, before we dive into the topic of compounding money in a tax-efficient way, we wanted to introduce the concept to everyone who might not be as familiar with it. And as such, we created a visual which will pop on the screen in just a moment. Here we go. Wonderful. Okay, so if there's one key takeaway from this session that you should remember, let it be this, that compounding money plus tax efficiency is probably the most powerful wealth building tool you'll ever find. So I'm not talking about a risky stock or a crypto bet or the expectation of a large inheritance or a winning lottery ticket, just talking about consistency and just waiting it out, really. And so what we're showing on this visual, if I can take your attention to the chart on the right, we are showing two different scenarios which share a lot of similarities, but that also have one stark difference. So in terms of the similarities, we are looking at the same monthly contribution, which are $100 per month. We are looking at those contributions that are being made from age 25 to age 65, so typical age for retirement. So we're looking at 40 years of investing $100 per month. And then we are looking at an annualized rate of return of 8% per year. The one difference, however, is that in scenario one, this $100 that's invested is done so in a tax-sheltered account, so a tax-free savings account. In Canada is a good example. In the United States, a Roth IRA is another example. And in scenario two, that money is invested in a taxable account where taxes will chip away at your gains every year. So now looking at the green line, we can see that that simple $100 per month grows to become $350,000 by age 65. So that's after 40 years. So that's quite remarkable. It's very notable. But then looking at the yellow line, the one that's right underneath, well, that's the same $100, but invested in a taxable account. And so over that same period of time, instead of $350,000, we have $222,000. Of course, it's still a lot of money. It's still sizable. But we're looking at a $128,000 difference or tax drag. So let that sink in. Same contribution, same amount of time, same return, but then one scenario leaves you almost $130,000 richer. I like to think it's magic, but it's not magic. It's simply investing your money in a smart way. So with that, I think that I've done enough talking, and I'd love to hear from our panelists. Is everyone ready to go?
Sure.
Yes.
Wonderful. So I thought we would start with Garrett, who's online. Hi, Garrett.
Hi, how are you?
Good. You?
Good, thank you.
Good. Thank you so much for joining us. Okay, so my first question for you, Garrett, I'd like to think that it's an impactful one in the sense where I think all of us here today, everyone who joined us online is a finance enthusiast, right? I'd say that we're all keen on making more money. I think that's fair to say. But welcome to real life. Many of us probably have to juggle many different financial priorities that are not just strictly investing, right? For example, paying down debt, right? And so at Neos Investments, I know that you are responsible for launching and managing ETFs, but you do so in a way that really allows investors to retain most of their gains. So I'd love to hear from you, how you're able to do that with your ETFs and why that's important given the context. And I'll also add that for those who are not as familiar with what an ETF is, if you can just also spend a few moments explaining what an ETF is, please.
Sure. So an ETF stands for an exchange-traded fund. And an exchange-traded funds means it's an investment strategy wrapped in a fund structure that's publicly traded on the major exchanges. So investors could buy one share of the fund at $25 or $50 or $100 and be able to start getting a very diversified portfolio and exposure to an institutional-based strategy in a very simple, easy way to own it in your portfolio. Here at Neos Investments, we really focus on, I love the chart you brought up, about tax-efficient investing. And we are primarily creating ETFs across all asset classes within your portfolio. So from equities to hedged equity, fixed income products, treasury-based products, alternatives like Bitcoin, like real estate. And what we want to focus on is really creating an investment strategy that is one of those core building blocks in your portfolio, but thinking exactly how that compounding wealth chart looks, of making sure your investment that you take home, the gains that you were just speaking about, right, are as big as they possibly can. And the way we're really doing that is saying in an equity-based product, we'll give equity exposure. We're going to do a option-based strategy that generates income, but we want to think about the investments we use, so those instruments within the strategy, but also the way as portfolio managers can manage the investments so that that net after tax, that take home, is as high as that gross distribution yield you're going to get. And then with us, you're getting to just choose your risk tolerance and exposure that you like. So whether that be the S&P 500 or core fixed income, Bitcoin. And so then we let the advisors or we let investors espouse really their views and risk tolerances. But ways to do that, as I mentioned, in a public fund, really focusing on what that net after tax return can be for investors through high monthly income distributions.
Thank you so much. I resonate with a lot of what you said, and in referring back to the example, to the visual, we did use an 8% as an example, which was really a conservative return on the S&P 500. But there are so many different options out there, and some that are very, very innovative, such as the Neos Investments ETF. So thank you very much for the explanation. So next up, we have Austin. I would love to for you to be next.
Sure.
Wonderful. Okay. So as you know already, Austin and Robert are the host of the Rich Habits podcast, which has quite the following, I would say. And so it's clear that you, in terms of your audience, we're looking at a very broad audience, right? If I had to guess, I'm sure that there's a lot of diversity in terms of age and occupation and stage of their lives, etc. And so thinking about that further, if you had one mindset, one money mindset, I should say, that you think people should change about how they think about money, what would it be?
Broke people react, wealthy people forecast, right? So unfortunately, I think a lot of people, no matter really where they are in their wealth building journey, when they first start out, they're reacting to life. Maybe their car breaks down, so they're reacting to that. Stock market goes up and down. Maybe they emotionally buy or sell. They're reacting to the things around them. Where I think a really big mindset shift that has helped me, and I know has helped a lot of our listeners, is to go from reacting to forecasting your future, right? So you're automating your investing, you've got your honest budget, you're doing everything right to set yourself up, put yourself in a situation where building wealth becomes inevitable.
I love it. Words of wisdom. And to anybody who's not familiar with the podcast, it's available on all the major platforms and definitely worth the listen. Thank you so much for that. Tom, I'd love to ask you a question next.
Absolutely, shoot.
Wonderful. Okay, so Tom, you work at StockTwits, which is a community that brings very keen investors and traders, right? And on your platform, which is a social network, people get to share content, live updates, and live insights and whatnot. And so can you tell me about how that access can help investors who are interested in learning about tax efficiency, how it can help them essentially?
Sure. So I think the biggest benefit to joining a community, whether it be StockTwits or Grit Capital or Reddit or any of these other online platforms, is, over the last decade, the issue has shifted from access, where 10 years ago you had to pay to trade stocks, you couldn't necessarily get all the same information that institutions had. Over the last decade, that's been the playing field has been leveled. So you can trade from your phone, it's free. In your phone today, you have more access than ever before. And so the problem is not access to information in markets, it's filtering it down to understand what is relevant to you. And so communities like StockTwits give you the opportunity to connect with like-minded investors who may have the same goals and strategies and experience or life situation that you do, and then you can learn from them. And so I think, when it comes to tax efficiency or any other strategy, right, the first step is discoverability. Before you can implement something, you have to understand that it exists and then see it used in practice. And so StockTwits does the job of bringing people together, making it clear where they stand in the markets, and then giving them the platform to share the knowledge that they've accumulated over the years. So it's all about access and filtering down the information.
I love that, because as one might become interested in a specific topic, it is so easy to get lost in trying to find the information. And sometimes there's just too much that's available, and then to know that there is a platform with like-minded people who are able to share insights that you might be interested in, I think it's wonderful. And a bit of a follow-up question for you, in terms of tax efficiency, are there specific, strategies or whatnot that have been picking up steam as of late on StockTwits?
Yeah, I think, obviously, we have different investors, traders, long-term, short-term. So they're all using different tax-efficient accounts differently. What I would say is we're seeing a lot of buzz around the tax-efficient products like Neos is putting out. People are looking for ways and products that will help them navigate the current volatility we've been seeing in the market. And so tax efficiency is definitely a part of that.
Wonderful. Thank you. Robert, you are next. So I like to think of Robert as someone who brings a lot of wisdom, and that is because Robert has a lot of experience. He's gone through a variety of market cycles. I'm sure that the volatility we're seeing in the market right now is not scaring you, right? You see, we want to hear from Robert. And so, Robert, given that experience that you bring, I would love to get your personal view on something, which is, we're talking about tax-efficient compounding of money, but is it really for everyone? And when I say everyone, of course, we tend to think of, a person that has a 9-to-5 job with a stable income, but, is it for you if you're an entrepreneur with an unstable income? Is it for you if you are already wealthy or not, right? Is it truly for everyone?
Absolutely, because one of the biggest parts of my message is getting people to start early and often. So many people, because they don't automate, like Austin alluded to, they invest when they get a hot tip in a crypto or a meme coin or something like that. And the key really is to invest early and often and have that automation in the Roth IRA or whatever tax efficiency you can find, like the Neos funds that we like. But also, I think the number one key factor for people to really let compounding work its magic is to change their mindset. So many people kick the can down the road until they're in their 40s, and they never switch that mindset, grow their mindset away from being consumer-based to investor-based. And I think that is the number one key component to building wealth, is thinking like an investor at all times and not a consumer.
I love that. Thank you so, so much. But fair to say that if you're in your 40s, you can still start investing, right?
Absolutely. Austin and I deal with it on a daily basis in the Rich Habits Network. So many people come to us and they're like, I'm 47, I'm 52, it's too late, wealth passed me by, and that's just ridiculous. There's still time to make up the difference. You just have to be a lot more serious about it when you don't have the luxury of time. And so it's never too late as long as you're willing to have the real conversation with yourself and your family, make the adjustments, make the cutbacks. Most people live beyond their means. Their house broke. They have 3 cars with payments of $800 or more in their driveway. You're going to have to make the important decisions and the changes to cut back to be able to get more money put away in a shorter period of time to let compounding and the profits help.
I love that, and I feel like that's going back to many of us having to juggle many different financial priorities. So thank you for that. And my last guest online, we're going back online to our friends at Neos Investments, Troy, last but not least. So going back to the ETF solutions that you provide, they're very innovative in that there's a focus on income and you use options to do that, which I believe will help manage volatility and really protect on the downside, which I think is a topic that's very relevant given what's happening in the markets for those who follow. And so can you speak to how you're able to do that and why it's important to not just focus on managing volatility and downside protection, but also to pair that with a tax-aware way of investing?
Sure. Now, if you think about going back to what Garrett said on the products we build, when we're building these products, we're trying to put in tax-efficient exposures, whether that's treasuries, whether that's using index options for the tax efficiency there. So as we think about volatility, and we've certainly seen it today and the past few days and past few weeks, volatility is not something to be afraid of. Yes, when volatility goes higher, usually the equity markets go lower, but it can be an opportunity for you to invest. And what we look at Neos in our suite of ETFs is really being a solutions provider and providing, as we talked about earlier, that exposure to equity indexes, whether that's the S&P 500 or the NASDAQ 100, exposure to ultra short duration with treasuries, or maybe some alternatives or other fixed income. So for us, it's really looking at how can you take and harness volatility into a portfolio to give you tax efficient income on a monthly basis, all while growing your portfolio over time. And that goes back to what Robert was saying with invest early, invest often, but do it in a tax efficient way.
It's so important to find the right solution for you. And of course, you have tools like StockTwits that can help you find solutions. You can use with a financial advisor, you can do your own research, but to know that there are those solutions out there that really help prevent a lot of what you discussed, right? Like the volatility, protecting on the downside, and doing it in a tax-efficient way is wonderful. So thank you for making those products available to all. And so we're a bit over time. We could keep on talking for a while, but I would love to close our session by asking each and every one of you in one sentence, if you have one advice you had to give to anyone who's looking to build their wealth in a tax-efficient way, what would it be? Austin, I'll start with you.
Open a Roth IRA, contribute $7,000 a year to it, invest it into the S&P 500, do that every single year for the next 40 years, and retire a tax-free millionaire.
Love it. That's how you can become a millionaire. Love it. Robert?
Don't kick the tax man down the road because we don't know what the taxes are going to be in 20, 30, 40 years. And just make sure that you do the tax efficiency game now. I think the Roth IRA is the most important thing anyone can have. And I think right now only 46% of US adults over 18 have a Roth IRA, and that's tragic.
Thank you for that. In Canada, tax-free savings account would be somewhat of an equivalent. Thank you for that. Tom?
Commit to a lifelong journey. Nobody masters markets in a day. You're going to have ups and downs. Start today, continue with it, stick with it, and find your community, find your tribe online and or in person, and just continue to treat it as the lifelong game that it is.
Thank you. And our friends online, Garrett?
Yeah, start investing as soon as you can. Find ways to cut any expenses and just keep putting money away. It will help. And don't worry about the down markets. Those are buying opportunities.
Don't worry about the down market. Fully agree. Fully agree. And Troy?
Yeah, I have to agree with everybody on the panel. I think start today, start investing as much as you can, even if that's $50, $100, whatever it is. Try to put that money aside and invest in the market, and you'll be happy. And really just become a student of the markets. Really always continue to educate yourself, and you'll continue to grow your wealth.
Words of wisdom. And just a bit of a personal example, my husband, who's in the audience, we had a child not that long ago. She's 16 months, and the first thing that we did when she was born, maybe a month after, is we opened a registered education savings plan. I think we're only putting $25 a month, just to say that there's something. But we know that with the power of compounding in a tax-efficient way, that will pay for a lot of her schooling when she's ready to go. So that's another way to think about tax-efficient compounding of money. So with that, we are over. So I believe we need to conclude our session, unfortunately, but thank you so much for everyone for listening, and thank you to our powerhouse of a panel for providing amazing insights.
Thank you.
Thanks for having us.
everyone.
Thank you.
Are you walking off and right back on?
No, I think you probably just you can walk off and back on.
Okay.
I think you would stay.
All right, that panel was very informative, and it reminds me of one of my favorite quotes that I either made up or stole it from somewhere. I can't remember, but the best time to invest is today, and the second best time is any day after that. So with that, we are going to get into our next panel, which is our Outlook 2025 panel. So today's a bit of a turbulent day on the stock market, not gonna lie, and I think probably scared a few people from coming in here today, but we've got 4 people that are going to talk to us about it, 4 experts. So we've got Robert Croak, who was just on stage with us. He's the co-host of the Rich Habits podcast, which is a top 10 podcast on Spotify. We've got my father, Michael Dechter, who is the CEO of LDIC and CIO. And we've got Katie Stockton, who is the founder of Fairlead Strategies and also a CNBC contributor and portfolio manager. And we have Caleb Silver, the editor-in-chief at Investopedia. So I'm gonna start off real quick and put everybody in the hot seat. And we're gonna look at this wonderful chart, if you could get it up on the screen. It's a beautiful chart of Berkshire Hathaway's cash pile. Here we have it here. As you can see, it's accelerated quite aggressively in the last couple of years. Buffett is storing under his pillow, not really under his pillow. He's obviously got it in T-bills, earning some interest, but he is not looking at a lot of bargains out there. He thinks it's better to be in cash. So my question to the panel is in a world right now that's full of noise, tariff wars, volatility, you got earnings growth slowing, you've got multiples compressing, policy uncertainty. What's that one signal? So in 30 seconds, I'm going to go around to each panelist. In 30 seconds, what is the one signal that you're watching most closely to guide your investment outlook for 2025? So I'm going to start off and put my own father in the hot seat. So Michael Dechter, what is it that you're looking at right now? What is that one signal?
I would like to see Warren Buffett put some of that cash to work in the market. That would be the clearest possible signal. He's only half in cash, so it would be a great signal to the market that multiples and valuations have come in to a Buffett buying range. He gave up quite a lot on the cash. So other people had 20% years, and he had a 4 or 5% year on the cash. So that would be my one.
All right, the Buffett signal. Katie, what's that one signal that you're looking at?
Hi, well, so I'm a technical analyst, which means I look at price trends. And with that in mind, I watch momentum. There's a very common momentum indicator called the MACD. That's short for moving average convergence divergence. It sounds fancy, but it's just based on moving averages of price. And it's designed to not only measure price momentum, but minimize noise. And what's happened just as of this month, we have our first sell signal for the S&P 500 in the monthly MACD indicator since the start of 2022. So that's what's on my radar.
All right, Caleb?
I'm going to go with the trust word, the big T word, which is super important, especially for retail investors that have been dutifully putting in their money in their 401ks and their IRAs and their Roth IRAs every couple of weeks, just like we told them to do, just like they've been taught to do throughout their investing career. I think we've reached a chasm here, not just with the tariffs, but with the trust in this government, in this administration, to lead the capital markets and this economy in the right direction. Now, we know they've made some very big moves in order to do that, but we just recently polled our readers at Investopedia. We do this every 2 months, and we ask them, what's your trust level in this administration to help you with your portfolio and make sure it's heading in the right direction over the next 4 years? 50% said they don't trust it. So I'm watching that very closely, because that commitment every 2 weeks, that relentless bid, that keeps the stock market up.
That's a very good point. Robert?
I'm going to piggyback right off of that with consumer sentiment. Right now, there is so much exhaustion in the markets, and everyone is so misguided. What does this tariff mean to the economy? How soon is it going to affect? And there's just so much fear in the market, and what everyone needs to understand is, when in doubt, zoom out. I couldn't say that enough, because so many people, especially newer investors, they just have these knee-jerk reactions to every headline, even if they don't understand the headline. We talk about clickbait all the time, and it is as bad as it's ever been in the financial and the crypto markets. So my message would be consumer sentiment, when in doubt, zoom out, and stop investing in a fearful mode, and start looking at it in years and decades rather than weeks and months, because so many people have knee-jerk reactions to powerful headlines without understanding them.
So speaking of fearful mode, mine would be credit markets. I started my career in 2008, and credit markets seized up. And when there's liquidity crunch in the stock market, which then has a ricochet effect over many, many asset classes, that's when you get a risk of more than just a correction, which we're experiencing right now, but you could really get a crash. And so right now, credit markets actually look good. Money is flowing, so that's the one that I'm looking at. Okay, switching gears slightly, Mag 7. So, the top 7 technology stocks that have been leading the way. If you didn't own them in the last couple of years, you're kicking yourself. And if you have a wealth advisor that, didn't own these for you, you're kicking that person. But we're having a slight change right now with a pullback in mega cap stocks. They are not dominating. And so there are actually signs of life, believe it or not, in other parts of the market, other industries, other sectors, other asset classes, other geographies. Europe's actually doing well right now. Gold's doing well right now. Copper's doing well right now. So there is actually some green shoots out there. So this is my question for Katie. Are we finally setting up for a broadening rally in terms of life in other asset classes? And if we are, where are you seeing this leadership emerge?
I don't think the word for it would be a broadening rally at this stage, because we are looking for, with that signal in mind, for one, more of a range-bound year for equities at best, and that's something that Europe won't likely be immune to, and even other sort of risk assets in general. So what has happened, I would argue, is a major shift, not a minor one, out of those mega cap stocks, something that sets the tone for this year as a year during which we will need to be a little bit creative. So I liked your point, like copper, gold. So some of the commodities have been quite strong and offered diversification, but also have proven to be sources of outperformance year to date alongside treasuries. So I think that we want to explore some other asset classes outside of equities while still maintaining a core exposure, of course. And if you do that zoom out, which I also appreciate, zooming out is very important, and trying to look past the short term is key in investing. When you zoom out and look at the charts of these mega caps, which include large cap tech and discretionary names like Amazon, like Apple, Microsoft, they look pretty toppy, right? They just very much have lost that long-term upside momentum. It doesn't mean the AI trade is dead. I think we're still going to see that resurface in price trends, but this is just an off year, is what our indicators are telling us. So what we can do in part is seek relative performance, right? So if it's a market environment where most things are going sideways to lower, we can look for relative strength, especially on the sector front. And we do that in our own ETF, which is called the Fairlead Tactical Sector ETF, or TAC, T-A-C-K. But listen, if you have relative performance that you're seeking, you still have the risk of seeing absolute losses. So it's a matter of protecting on the downside.
And so let's talk about losses from a personal standpoint. So Robert, you have a podcast where you interview CEOs, billionaires, and you have a pretty extensive network. So from a more personal standpoint, in these conversations you're having, what are these people doing with their money? Are they scared? Are they saying, oh, wow, I'm really excited for the market to pull back because, I'm going to be greedy when others are fearful? Or what are these conversations that are happening and what are their outlooks?
The answer is no, and I think most wealthy people and my friends, let's call it $50 million to $5 billion, the people that I work with, partners and so on and so forth, they're just diversifying. They're getting a little more risk off from the mega, the big tech and all of that. But I still believe that there is a lot of room to go in AI, maybe not as much in hardware, but more in software. Gold and silver is something that I've been very bullish on for quite a while. Nuclear. We're looking at a lot of pre-IPO stuff in humanoid robotics. Nuclear, I think, is a strong category right now that people should be watching because for the U.S. market to really grow where we're trying to go and bring manufacturing back, we don't have nearly enough power and we don't have nearly enough of these, big mega factories and warehousing. So I think there's just more. All of my friends are diversifying and doing a lot more in kind of these alternative asset categories.
Yeah, and I mean, that also comes with kind of an age and stage as well of where your wealth is at, that diversification, taking your asset allocation risk down. We're seeing that a lot in our business where, we'll have people call and, they're 80 years old and they're sort of saying, I've had fun with the Mag 7, but, fixed income, I can sort of earn a good return now. So maybe we'll shift over to that. So in terms of sentiment on that note, and Caleb, you spoke about that at the top of the panel, how are you seeing that shift in the data? Let's dig into that a little bit more because your platform is all about the retail investor, right? So what is happening in that data that you're seeing with sentiment shift in 2025, and how do you think it's going to affect the market going forward?
Well, they're as cautious as they've been since we started surveying them about 5 years ago, pre-pandemic. So that just tells you they are scared as they've been, and this recent sell-off is not helping matters. You talk about the Mag 7, and we have a lot of exposure. We've been over-concentrated there. I've spoken to Katie Stockton many times about this. She was all over it. Price doesn't lie. And the one problem is those are the stocks that we own as retail investors. So it's really hard to avoid them if you're buying an S&P 500 ETF or if you're buying a NASDAQ ETF. They are there. They are concentrated in every big portfolio. They're the most widely held stocks on the planet. Not only that, but when we ask our readers, what stocks do you own? What are your top stocks? It looks just like that. The Mag 7 plus a few other stocks like Berkshire Hathaway, potentially like a JPMorgan. The other problem is when we ask them what stocks would you buy and hold today and hold for the next 10 years, they're the same stocks by and large. So they're addicted to big, large stocks, and those are the ones that have been driving market gains. Now that they've slipped, now that they've had a correction and even more in some cases, investors are going to have to rediscover how to invest again, fundamentally speaking, and how to really look at things like price, like momentum, and also look outside of where everybody's been running. It's very hard for the herd to do that. I bet you nobody had Poland on their bingo card. It's the top performing stock market this year so far. It's an anomaly, but if you look around the world, there's plenty of other stock markets that are doing much better than the United States, and there's plenty of other stocks that are doing much better than the Mag 7, big tech, or consumer discretionary. So they're scared. That hasn't stopped retail investors, though, from piling into the market, not all of them, some of them, trying to buy this dip over the last 3 weeks. They've gotten burned very badly doing so.
And I think that's the key. You said it right there. Rediscovering how to invest again, especially it feels like that every day we're having to do that with the headlines. So I've kept one of the more difficult questions for my own father about Trump. Trump being back in office, making all sorts of changes, whether it's cutting government spending with DOGE, proposing new tax cuts, trying to increase revenue through tariffs, reciprocal tariffs. I mean, it's dizzying out there. So as a money manager for the past 26 years who've lived through many of these different crashes, corrections, everything, and we should remind ourselves the S&P 500 has kept making new highs through all of that. What are you seeing, Michael, is the most underpriced risk that people are not paying attention to? And then what is the most unexpected opportunity that people are not paying attention to, in your opinion?
I would say both of them are the major shift in world trade relations that is being triggered by President Trump's initiative on tariffs. And I think that the moment of greatest anxiety and therefore greatest risk is actually today. The announcement was made yesterday. He has set an extreme set of goalposts, extreme in the sense that they're onerous on all of the trading partners of the U.S. He was a little milder on Mexico and Canada because he'd hit them already. But this is the moment of maximum pain. And there will now be a vast number of negotiations, big and small, between the U.S. and other governments, within companies. Today, a plant was closed for 2 weeks by Stellantis in Windsor, Ontario, and GM announced that it was adding additional workers in Wayne, the Wayne plant, to make more trucks. So that's a tiny example of the million things that are going to be driven by what happened yesterday. There was a run-up to it, but it is the largest change in how trade is going to happen on this planet since post-World War II global institutions. So that's where both peril and opportunity lie, and understanding it, the detail of it, is going to be hugely important. And I just, diversification is important, but also really follow the detail of this. There are going to be big winners. There are going to be, even today, big losers. And it's not going to be consistent. Some people that look like they're winning may later lose, and vice versa. So this is the central issue, and everything else is going to follow from it. If this drives some inflation, it will affect interest rates. If it doesn't, the Fed will cut to strengthen the economy. So, it seems like it's incredibly complex, and yet it comes down to this. President Trump wants to move manufacturing back into the United States, and he's willing to take a pounding, I believe, economically and politically, for a couple of quarters at least to achieve that goal. And he's already had some success on that front. So it's just going to be very hard as an investor to watch the level of volatility that this produces.
And I think you nailed it there with the diversification. One line that somebody told me always stuck with me: if you don't hate a certain part of your portfolio, you're not diversified enough. So remember that. All right, well, we're wrapping up the panel here, and I'm going to hit you all with another quick one. And I'm sorry to do this to you because I didn't send this information ahead of time. But if I were to give you $1 million today, where would you put this $1 million? I'm going to start off with Robert because he just sighed.
Of course. Without more context of what I'm doing with it and no idea of where we're starting, is it my first $1 million or the 11th $1 million?
I'm going to say it's your first $1 million, and you can only put it in one place.
In one sector? Oh, gosh.
Well, it's one asset class.
I would say for me, it would be humanoid robotics or nuclear.
Wow. Caleb?
I think I would say water, private water companies. I think water is going to be a scarcity. We're going to have to deal with it. Climate's going to be an issue. And I'm thinking water is the thing we're going to need to have pretty close by for a very long time.
Well, that bottle's gone from $1 to $4 at the airport. So
Sipping it slow.
Faster than inflation. Michael, where would you put $1 million?
Utilities and energy.
And Katie?
They've been really out of fashion. And I think AI can be played on the energy side, and I think utilities are yielding better than bonds at this point. So,
great. Katie?
I would say something that is inherently diversified, like an active ETF. Tech is the obvious choice for me as its manager, but what I would say is to put, a good portion of that $1 million into an active ETF that is conservative and gives you a nice core and obviously will work for you. And then you'll have some cash to put to work in higher beta stocks when the market warrants it.
Fantastic. All right, well, we're going to wrap up. I would put my $1 million in a small interest on Sahil Bloom's future sales of his next New York Times bestseller, which he'll be writing. So, all right, with that, thank you so much. We'll move on to the next panel.
Thank you.
Thank you.
Bye, Katie.
See you, Caleb. Nice to see you.
What's up, everybody? Really cool panel coming up here. 10x ideas for the next 10 years. Get excited. What's up, Brado? Well, we got some folks helping us with our seating arrangement. Do you guys want to hear some jokes while we wait? All right, here we go. What do you call a can of cold beans? Chili. What do you call a bear in the rain? A drizzly bear. How do you get a tissue to dance? Give it a little boogie. All right, sorry. We're back.
Is this on? What did I tell you about the dad jokes?
The dad jokes are unbeatable. They're great. People love dad jokes.
We've worked together for 5 years. I beg him not to do them, and he always does them.
Okay, so I will be moderating this incredible panel. We've got some awesome people here. We've got Alex Tapscott, my friend. He's a portfolio manager, managing director, and a best-selling author. We have Sue O'Reilly. We just became friends today. She's incredible. She is the founder of The Positive Point. We've got Christian Blackwell right over there. He's my co-founder of Wits Ventures and the general manager of Grit, so really good guy to know. Virtually tuning in, we have Bill Ty. He's a venture capitalist, an athlete, an adjunct professor, an early investor as well into Lineage, Canva, and Dapper Labs. And tuning in, I see Chris Camillo's hanging out with us. He should have his camera on here pretty soon. But he is the guy that famously turned, there he is, what's up, Chris? He's the guy that famously turned $30,000 into $60 million. He's also the co-host of the Dumb Money Live YouTube channel. Definitely go subscribe and check them out. So this panel is all about 10x ideas for the next 10 years. Really this idea of like building generational wealth, right? So Bitcoin is now the 7th largest asset in the world. AI has fueled much of the S&P 500's growth since the 2022 bottom. And humanoid robotics are here. The future is here, and it's moving quite fast. We're joined by some of the world's top investors as they share their next 10x ideas for the next 10 years. Now, the first person I want to have a conversation here with is Alex. Alex, nearly a decade ago, you co-authored the book Blockchain Revolution: How the Technology Behind Bitcoin is Changing Money, Business, and the World. Fast forward 10 years later, it's now 2025. We have a pro-crypto US government, we have a strategic Bitcoin reserve, and Bitcoin as of, well, I wrote this yesterday, but 1.7-ish trillion in market cap. I think it's down a couple today. Anyway, Bitcoin is big, right? So my question is, where does Bitcoin go from here? Is Bitcoin still a 10x idea for the next 10 years?
Well, what's that old joke about predictions? They're like a body part, everybody has them. What I would say is that, when I first learned about Bitcoin was back in 2014. And this was before the word blockchain or crypto or Web3 or any of these other terms entered the vernacular. There was this one single asset. And it, at the time, I think had a market cap of like $5 billion. So if it was a publicly traded company, it would have not even cracked the S&P 500. It would have been considered like a small cap stock. But I noticed that a lot of people were using this technology, using this asset class online, and I became really interested in it. And the more I looked at Bitcoin, the more convinced I became that this was more than just a speculative asset. People weren't just using this thing hoping that it might go up. This was something that was being used in a real sense, but also that the underlying technology of the blockchain represented a fundamental shift in computer science. For decades, we had an internet of information, which changed how we moved and shared information, democratized information. But it wasn't actually that good for money or for assets. Because when you use the web to send information, you're not sending an original, unique thing. You're sending a version or a copy. So If I send you an email, I can send the same email to every person in this room. If I host a website, anybody can access it. If I post something on Twitter, it's available for all to see. So the web, the first era of the internet, was kind of like a printing press for information, right? And like the first era of the printing press, it had this amazingly positive impact on how we access information. But when it comes to things that have value, being able to send copies of something is not such a good idea. If I owe you 20 bucks, it's important that when I send it to you, you know you have the only version of its kind, that I can't send the same $20 to someone else. Because if I can copy money like I can copy information, the money becomes worthless. And that's true for every asset. If I sell you a share of Apple, it's important you know I can't sell the same share to someone else, right? How do you know that that asset is one of a kind? How can you trust? And that's all made possible by the technology behind Bitcoin. So this is a long-winded way of answering your question. But at the time, in 2014, a lot of people saw Bitcoin as a platform, not just as a digital store of value or as digital gold that you could hold in your portfolio as a way to diversify or as a hedge against currency devaluation, which it is and remains so to this day, but also as a platform, as a new technology platform that could be used to program all kinds of assets, to be used as a way to move and store value in any marketplace. And that didn't happen for the first 10 years of Bitcoin's existence. And yet, it still managed to achieve the valuation of $1.7 trillion. So they say there's nothing so powerful as an idea whose time has come, again, in this case, because now Bitcoin is re-emerging in this moment as not only a monetary asset, not only as a store of value that's now widely held by retail and institutional investors, by governments and by central banks, but is also emerging as a platform. And a lot of smart developers are thinking about how they can use it. So if Bitcoin today is at 85 grand, for it to get to 10x, to be a 10x investment, you're looking at $1 million. For it to get that big on being digital gold alone, on a digital store of value, it would have to get almost as large as the total market value of all investable gold in the world. That's what $1 million means from here. Is that possible? Maybe, you know. Gold is a store of value for the industrial economy. Maybe Bitcoin is a store of value for the digital economy. But the real growth is actually going to come from something else. And it's going to come from something that people aren't actually paying attention to, which is Bitcoin as a platform. And that's, to me, the thing that I'm most excited about.
That's incredible. I appreciate that breakdown. And as someone who owns some Bitcoin, I hope it goes to $1 million. Sue, how's it going? So we were chatting before this, and you had shared with me your 10x idea and what you're excited about, but I really want to better understand and make sure the audience listening understands, right? You are a TA expert, technical analysis.
I love technical analysis.
Which allows you to blend the fundamentals of a company or whatever you're investing into with near-term price action. So one, what is your 10x idea? And two, how can our listeners use technical analysis when they have their own 10x idea to ensure that they're not getting in at the wrong price?
Oh, that's a great question. So my 10x idea, the one that I wanted to share with you today, starts with understanding the global power game that's taking place in the world today. And so the tariffs, the mainstream conversation about the tariffs is that it's about immigration, fentanyl, dairy, but I think that there's a subtext going on that's really important to pay attention to, and that subtext is energy security. And so globalization caused the US to step back in terms of their mining and production of rare earths and precious minerals and uranium. So my 10x idea is uranium. And so they're in catch-up mode right now. And so I think that the tariffs are not a punishment to Canada. I think they're a positioning and getting a good leverage over uranium and those precious metals. So currently, the US depends on other countries for 90% of their uranium and precious metals. And uranium, with this whole AI push and the energy needs that it's going to create, is at the fulcrum of all of this. So I believe that we're in a uranium renaissance that started in 2020. If you look at a chart, and I'm like Robert, I like to zoom out. And so if you look at a chart, a 20-year chart of uranium on a monthly time frame, you'll see this huge spike in 2020, and it had this massive rise into 24. It's backed up about 40% now, and it's sitting at a very, very strong area of support. So to answer your question, look at the 50-period moving average on a monthly time frame, and when you see a positive candle, and if I'm right about support coming in, that candle will come in April or May. You just want to get right in underneath it and ride the wave, because I think it's going to last for decades. And so the U.S. has to catch up. It's energy security. They want to come to Canada. They do not want to go to other places, hostile regimes for their uranium. So
that's a wonderful answer.
Thank you.
Uranium. And I think the ETF you were alluding to
That's
before
right.
was URA.
Thank you for reminding me. So as Canadians, we have so many choices, right? We have Cameco and Denison Mines. So you don't have to convert your Canadian dollars, but if you do have US dollars, there's an ETF. It's URA. It has a 7% yield as of today, over 7%. And so that's a beautiful hedge against inflation as well. So look for that monthly candle in April or May, and you get right in underneath it. You'll get that beautiful dividend and I think decades of upside.
Thank you so much. Christian, how's it going, my friend?
How we doing?
So one of my favorite quotes is from Gary Vee. It is, ideas are shit, execution is everything, right? We have invested into dozens of startups together as my co-founder of Wits Ventures over the last half decade, and a handful of them have failed since. When you look to invest, right, either into a private company, a public company, whatever you're looking to invest into, what characteristics of the company's management team stick out to you as this company is going to be a winner, or no, I just don't see it. These people can't execute, despite the idea being pretty good?
Yeah, a few things come to mind. I really think there's a difference between private and public investments there. I think when we've had private investments that have been L's, which not all of them have, but it's kind of like baseball. If you're batting 400, you're doing incredibly well. I feel like with a lot of those founders, they were never feeling the heat. So that's a big part of it, is like, if this company goes down, what's going to happen to them? Or are they just treating it as a salary until the wheels fall off? So I think that's really important to keep it brief for the private side of things. For the public side of things, I kind of honestly want to make a sports analogy. Like, I'm a massive football fan, American football, and I always think about when a new head coach is hired, the first thing that people ask is, where else were they a head coach? Because if they weren't a head coach somewhere else, then you better be damn sure that they have a lot of intangibles. They're very intellectually sound. Because you're taking a gamble on them. So a lot of times with public founders, I research, okay, where have they been? What have they been doing? Like, is this just a company that was a startup? They took it public, and this is kind of their first roadshow here. So that's kind of two different ways to think about it. I mean, there's a million different things, but to keep it brief with the time we have left, that's kind of the two ways I would think of it.
I love it. I immediately go and think about Starbucks, right? They hired the old CEO of Chipotle, and I think even before that, he was doing stuff at like Taco Bell.
Yep.
Very cool. Bill, how's it going? Hopefully you can hear me and see me okay, my friend.
Yep, all good here.
Perfect. I want to dig into some real names, some real ideas. Bill, you've been an early investor into some of the largest privately held companies today. What's around the corner? Is it a niche that is being disrupted by AI, like defense right now? Is it a completely different technology that you might be excited about, or maybe something along the value chain? Where are you deploying capital right now? Like, just very actionable.
Sure.
Here's where it's going.
Yeah. So first of all, I think to get to very big companies, you have to operate in very big markets that are going through some kind of structural change. I think back to Alex's point, even though Bitcoin has gone a lot, I think it's the easy 10x opportunity, because it's basically redoing the world of finance. Where I'm deploying right now, I think there's two areas that are front of mind. I think most of you may be in Canada, but the United States, the U.S. healthcare system is completely broken, and it's 19% of GDP. There are something like 100 million out of 300 some odd million Americans in medical debt because the incentive systems are all broken here. So I'm deploying capital into semantic AI in the healthcare space. I do have a company that I funded called Dyad.net. I took the engineering team out of Cambridge Analytica and we pointed them at the healthcare industry. They launched a product about 7 months ago. It's growing 25% a month, very, very steadily. There's another area that I'm quite intrigued with. I do happen also to be the first investor in Zoom Video. The guy that built the product we're using right now, he was the head of product for 8 years at Zoom. He and I backed the former head of all real-time products at Meta. One of the areas that's been talked about for a long time, but really hasn't broken through in standard commercial markets is the creator economy. You are seeing some incredible revenue generation and margin structures and things like OnlyFans. So this team that has been put together that includes guys like Matt Sorum from Guns N' Roses, Jerry Steinberg that launched ESPN, and some other people with prominent positions in the creator economy, have launched a product literally yesterday called Gigaverse. And it's basically a more consumer, community-first video platform to drive engagement. And that also is, obviously the social media space is one of the few spaces where you can create companies that can, in the outside shot, get to $1 trillion to $3 trillion in value.
Bill, that was a wonderful breakdown. I appreciate the call outs, the names, the trends, everything you're looking at there. Chris, want to make sure we get you in here as well, my friend. Again, the title of this is 10x Ideas for the Next 10 Years. And I think it's kind of cool because, Chris, you recently experienced a 10 to 20x markup on some of your early investments in humanoid robotics. So, one, please share with us briefly why you are so bullish on humanoid robotics for the next 10 years. And two, how can retail investors listening right now invest into this asset class, this trend of humanoid robotics, despite some of the largest players being privately held?
Yeah. So first of all, I think a lot of people don't understand that close to half of global GDP is physical labor, right? And if you would speak to any CEO, just about every sector on earth is limited, meaning the bottleneck to that sector growing is usually physical labor, right? The cost of physical labor, and even cost aside, just the ability to expand physical labor, because there are only so many humans and we're only capable of doing so many things at the same time. Never in our history, in my history as an investor, do I remember a moment in time where every single big tech company in the world, just about every single one, was either publicly or privately focused on creating the same product. So whether we're talking about Apple, where they've moved their entire automotive division, from what I understand, to their humanoid project, Amazon, OpenAI, Google, in their recent partnership with the company that we're invested in, Aptronic, SoftBank, every big tech company in China. All of the world's biggest companies are focused on one thing right now. And I won't even use the word humanoids because it sounds so Star Trek-y. This is really a story about the embodiment of AI. So it's about the expression of artificial intelligence through the physical form. It's inevitable. I believe it will be the largest industry we've ever known as humans at some point in the next 20 years. And the reason for that is we're essentially leveraging AI to build infinite labor machines. Some of them might look like humans, humanoids. Some of them might look nothing like humans. But the really important thing is we've had this bottleneck even within robotics that have been very precision oriented for the past few decades, meaning it's very expensive and it takes a long time to build a robot to do one thing because they're so precision oriented. Well, now that robots have AI brains, they can work more like humans. They don't need to be as expensive or as sophisticated to achieve the same task that we used to require a precision piece of robotics at a factory. So that's why all the world's biggest minds and tech companies are in this space. That's why guys like Jensen can't stop talking about it in NVIDIA. And I know you're wanting to ask this. How do you invest in it, right? They're all private. Right. Well, obviously there's one public company, Tesla with their Optimus program. The two other big companies in North America in the humanoid section are Aptronic and Figure AI. They are private, but you can invest through secondary markets. There are employees always selling shares, and there are a bunch of secondary markets out there as long as you're an accredited investor. But more importantly than that, we could think about all the companies that will benefit from this. Now imagine a world in 20 years, 25 years, where we have an infinite labor machine, where industry is unrestricted to grow, where new industries can develop, who is most likely to benefit from that? Well, obviously, I just told you NVIDIA is kind of powering a lot of this space. So that's one right there. But companies like Amazon, right? Think about a company like Amazon that already has the global logistics supply chain locked up, right, for productization globally. Imagine if a company like that can lower its cost of goods, its cost of logistics by 25 or 30% or 40%. What does that do to a company like Amazon? And there's many stories like that. So you could either invest in the companies enabling this or the companies benefiting from this. But I actually believe there will be many 10x opportunities over the course of the coming decade.
Chris, you are the best, man. Thank you so much for breaking that down for everyone. As you can tell, Chris understands this humanoid robotic stuff pretty well, and he's pretty bullish on it. That is all the time we have for the 10x ideas for the next 10 years. So everyone, thank you so much for tuning in, and let's keep on rolling. Thanks so much, Chris.
Thank you, guys.
Okay, our next guest is one that I'm super psyched about. Few embody entrepreneurial grit and versatility like Michelle Romano. She became the youngest dragon on Dragon's Den at 29, and she launched 6 companies before the age of 35, including one that she sold a Groupon. She also is one of the co-founders of Clearco, a fintech trailblazer that has invested over $3.2 billion into 7,000 startups across 13 countries, making it one of the largest e-commerce investors in the world. And Michelle's been named one of Forbes' top 20 most disruptive millennials on a mission. She also serves on the board of Vail Resorts and Freshie, and she speaks all around the world. And we're so pleased to have her today. And if anybody knows the power of building multiple income streams, which is the topic of our conversation today, it is her. So welcome, Michelle. Woo!
Hi there, it's good to be here.
And I also just want to chime in and make sure we're on the same page. Dragon's Den is equivalent to Shark Tank in America. So it's pretty cool. Pretty cool.
It's very cool. I don't know which came first, but, you know.
Dragon's Den. It's usually the Americans that are first, but this time the Canadians were 5 years ahead, and it was actually 2 Canadians that brought Robert and Kevin brought the show to the U.S., which is a pretty cool story.
Yeah, Canada first. All right. Well, speaking of firsts, our parents, so speaking of generational shifts, our parents often built wealth with one steady job, being at one company for a long period of time. But today, all that has changed, right? So the workforce has been reorganized. We've got gig, we've got AI, we've got, you know, lots of layoffs happening in, you know, faster cycles. And so it feels like the entire economy is moving so much faster and nothing is really guaranteed in the world today. So now more than ever, it's important to have multiple income streams. I think the average millionaire has 7 income streams. So Michelle, why is it no longer optional but essential to have multiple income streams on the go?
I just think the economy got pretty crazy pretty fast. It's maybe the best way to think about it. And so, you know, we've inflated everything. It's costing more to do anything right now. And so therefore you just have a lot more to do. But I want to be really cautious with this. You want to think about multiple income streams in terms of, like, you know, making money, investing that money, having different investments, having a side hustle. But the way you make real wealth is when you have something that's working at the right moment, at the right time, you have to double down on that and put all of your focus behind that. And so as you're kind of figuring things out and as you're running experiments, that's kind of an okay time to be focused on many different things. But I think one of the things that I look at is that if I wouldn't have ever committed to building some of these startups, it took years, it was a long time, there would have never been, a big company created, which ultimately created, and then that in itself developed more exciting things, because then, for me, I became a personality and there was other things associated with doing that. But I think especially early in your career, you want to be trying lots of things, but you don't want it and it's really, you have that moment to figure out when it's working, when you just like have something without a lot of marketing that's like taking off, you got to focus on it.
It's like the old Russian proverb, if you try and catch two rabbits, you'll catch none, right? So at some point you do have to focus.
So something about your intro bio really stood out to me. $3.2 billion invested into thousands of startups. That is unreal to even think about. So my question for you is, and think about this too, because like we've got so many people at home and in the audience here that are excited to either make their first private investment or they're looking in the public markets and they're excited to start investing more aggressively. If you had $100,000 right now to invest, what would it be invested in? Let's say privately. Let's start private. So like you've invested all this money into private companies. If you had $100,000 to invest into a privately held company, what sector are they operating in? What technology? Like give me a brief sort of description of the type of company you're investing into.
And is this your last $100,000 or part of a much larger portfolio?
However you want to answer that question.
Okay. So I think you should have some diversification, even with $100,000, right? There is, part of my world is investing in different ventures, and those are always high risk, right? There's 90% of them fail, but the ones that do really well are incredible. And so I always think there should be that high risk portion of your portfolio that should be really balanced. If it's your last $100,000, I would never suggest you put that all into one startup, and I've always been that cautious. I think still the most important bet you can make is yourself. And so if you can find out a way to test something, trial something, figure out some asymmetric information yourself, that's still going to pay dividends, probably the most. And then, it depends on which stage of life you're in. If you're in the stage where you're not looking to work 100 hours a week and be crazy, I think it's probably going to be a real estate investment in many of these countries where we've seen, mass amounts of immigration. There's still lots of upside to be had, and so I think there's probably a part of that. And so with 100,000, I don't think it's one property, but maybe it's a piece of exposure to that market.
I think that's a wonderful answer, right? Investing in yourself, and of course real estate, but the idea of like investing in yourself is so incredibly powerful. I think the phrase goes like, rich people buy their time back where ambitious people buy skills. And so what you're saying is to go, if you're that ambitious person, go buy that skill, if it's sales, if it's whatever else that might be out there for you, that will allow you to turn the $100,000 investment into millions throughout your lifetime.
And I think that it's also really important. Sometimes when people think invest in themselves, they think, well, I need to go to school or I need to have something very formal that I'm paying for to get a skill. Usually the best way to develop a skill is to do something. I mean, the best founders are the ones that just have starting, tons of different companies. And so oftentimes that means invest in yourself. It means, I'm not going to take a salary, but I'm going to go work for someone that I think is incredible. And really take the time to learn from the best, right? That doesn't look like a traditional education model or an investment that way, but that's probably going to give you the biggest return, because it's like you said earlier, with AI changing so fast, with industries changing so fast, I don't think the education system has kept up with even the skills that are required today versus what they were 2 years ago.
Yeah, and on that note, Michelle, I've watched so many of your interviews where you say this wonderful thing about, throw out the business plan, right? A business plan should just fit on a napkin. And so where that applies more than ever is when we're going through a chaotic time, right? And I know that you've started businesses and invested businesses, both in 2008 during that crisis, both during COVID as well. And there's been wonderful businesses and industries that have come out of, I love the saying, never let a good crisis go to waste, because really you shouldn't. And so my question to you would be, how does one build conviction, bet on something when it still looks crazy and everybody else is saying, I want to hide? Like, where do you pull that conviction from?
I think what you have to remember is that a lot of great businesses were built during recessions because most people are willing to change their behavior. Usually it's very expensive to get people's attention. That's just generally how it is. When you look at any sort of online marketing, offline marketing, it's just very expensive to get attention. But when you have a big shift in a market, a COVID, a 2008, everyone's willing to say, oh, well, I'm willing to try something new. And so I always think about, 2008 is where, I grew up a little bit because I was just starting to be an entrepreneur then. And I mean, that was when Airbnb started. I mean, people thought it was crazy that you stay in a random person's house. That is now the most mainstream thing we can think about. But it was because at that point, people were saying, well, this is all a bit expensive. If there's something cheaper that makes more sense than locking your inventory, I'm willing to do that. Same thing. Uber was in that era. Groupon was in that era. There were so many things that people were looking for cheaper solutions. And so then they were willing to try all sorts of things. And so I think it's reframing your mindset around this is the moment to try, which is driving that conviction that you're getting to. And then there's usually cheaper ways to do things when markets are fluctuating because everything's a little bit up for grabs. But it's always scary. You'll never have all the data. I always say by the time McKinsey's written a report of an industry, it's already been formed. There's already multiple billion-dollar players. And listening to customers on the ground will give you a really good sense of, is this going to work or not?
Yeah, and I think what you said about being crazy to let somebody live in your house back in 2008, and look what happened to Airbnb. I think now, this time around, it's like crazy to think that you're feeding information into an AI, like personal information, financial information, and just sharing it. I'm talking about ChatGPT and other iterations of this, and that would be really crazy. But now, these robots know and these AIs know a lot about us. And so we'll have to see what comes next out of that in the next few years. But we are running out of time here. So I'm going to say thank you so much, Michelle. And next time we want to have you here in person on the stage.
Yes. Well, I would love to join you next time. It was great to be here. Thank you.
All right. Thanks, Michelle.
All right. I have ran out of jokes. Does this thing still on? There we go. I have no more jokes for you guys. I'm sorry. Just have to wait.
Is this one on? Oh, I'm just going to come hang out with you.
How we doing?
We got so many people who wanted to be on this one. I have to sit in the less cool chair.
That's a cool chair.
It's cool, but that's like director cool,
We got a wild cap of a bottle here.
And my mom is totally watching, and she's going to be really pissed off because I took 5 years to get headshots, and I am not John Ehrlichman. So,
yeah, I feel like maybe shout out to my dad, shout out to Ireland. I think they're probably watching. Shout out to Anne Blackwell, Christian's mom.
My mom follows like 12 people on Instagram, and Austin might be 10 of them. So all she does is just watch Austin stuff. It's kind of weird.
Thank you guys so much, by the way, for coming out to this. Like, unreal. Super excited that you guys are here. I hope you guys have been, getting value from this. We really worked hard to pull together people that have got really meaningful things to say. And I am just super jazzed that all of you decided to come. And I know to the countless of you that are watching online live right now, it's just really means a lot to us. So thank you so much. Seriously.
100%. Well, before we get started, John Ehrlichman was supposed to be moderating this. He and his family are all really, really sick, so our thoughts and prayers are going out to them. He was actually in the hospital yesterday, which is really sad. So they found me on the side of the road and asked if I could moderate this, and it's going to be the best panel of the day. So
Whoa! I had a pretty good one.
No, you're in all of them. So this is Austin. Austin, head analyst at Grit, my business partner for a long time. Robert Croak, serial entrepreneur, co-host of the Rich Habits podcast with Austin, founder of Silly Bands. Tom Bruni, coming live from Manhattan, from StockTwits. He is the editor-in-chief of StockTwits and the VP of Community. Jessica Casaba, pronounced correctly.
Rebecca.
Oh my gosh, Jessica. Rebecca. I was just
Still the
texting
best
somebody
panel
called.
of the day.
That is really bad.
He literally
Worst-
just got here, so gotta give him a break.
I'm so sorry. I was just texting somebody, Jessica. Rebecca Casaba, co-founder and CEO of Dealmaker, and Eric Bernofsky, the CEO of Grit Capital. So,
and joining us virtually is Zaid.
oh, he's already popped up. I didn't know if he was in.
What's up, Zaid?
God,
How's it going,
you
my
look
friend?
incredible.
Live? Oh, glad I wasn't picking my nose. What's up?
You guys
are
might
definitely
recognize
right.
Zaid. He is the host of the Rundown podcast by Public.com. He's an incredible podcast host as well.
And Zaid, I think you're one of the 12 people my mom follows on Instagram too, so you should.
Oh, shout out. Appreciate it.
You should take that very seriously. But the title of this panel is all about the rise of the DIY investor, the do-it-yourself investor. So we're going to start out with Tom, coming from StockTwits. So Tom, retail investors are often criticized for following hype, especially nowadays. What are some ways that they can use online communities like StockTwits to make better decisions?
Yeah, great. Thanks for having me. I think there's a narrative out there that retail investors tend to be all in. They just chase the GameStop moves, the Bitcoins, the meme coins that are out there. And there's certainly aspects of that, but what we find is most people are taking what I like to call a core and explore type approach, where they have their core investments, 75% of their assets, they're putting in low and slow index funds, tax-deferred, tax-free accounts, saving for that long-term goal, and then they do some exploring with the other 25%. So that's where they can experiment, with the cryptocurrency, with higher beta stocks. Ultimately, discoverability is a positive. So nobody gets involved in the market, or fewer people get involved in the market because they hear about a 401k. These investments have been around for a long time. They don't get people super excited about being rich 40 years from now. Typically, how people find the market is they hear about their best friend or cousin or somebody getting rich on like a random penny stock or GameStop or whatever. So, a lot of people approach the market that way initially, but then they learn that they have to, as they're growing up in their investing journey, they have to get a bit more serious and treat it as a business and as not as a game. So I think StockTwits does a great job of enabling people to share their experience so that others can learn from it, and connecting you with experts in various different fields. And again, like community, whether it be Grit or StockTwits or any other online community or in person, the goal is to make money in the markets. We're all here for the same reason, and so leveraging each other's experience and helping each other out is part of that lifelong journey.
I love it. Great answer. Eric, we'll jump down to you. So how do you see financial media and content evolving in a world where more investors are relying on influencers and newsletters and short-form content as their key source of insights?
Like some of the folks on the panel?
Yeah, like a lot of the folks on the panel.
First off, I also just wanted to comment, 4 out of the 6 people have been on a panel already today. So Rebecca and I are newbies here, so cut us a little bit of slack, because you guys already had some mulligans on the course, and you're doing it over again. So
Agreed.
There you go. Thank you. Including your name mistake, by the way.
She's still mad about it.
Back to the regularly scheduled programming. I think that to answer the question, the democratization of so many industries, and it was mentioned before, we talked about Airbnb and Uber, the media industry, the democratization of media has been such an opportunity for so many people. You have a phone, you have a camera, you can get going and you can create content. That's an opportunity, but it's also a threat. And the opportunity is, if you're listening to the right people, it can be very, very powerful. But my one advice would be, for those listening, is you have to understand, are you listening to entertainment or are you listening to education? And there's a big, big, big difference. And again, it was said before in one of the panels, looking at CEOs, looking at investments, have people been there and done that before? If you're watching a creator, you're looking at a creator, you're ingesting their content, what credibility do they have? Are they just a pretty face, like Austin? Or
I'll take it.
or do they have some credibility with what they're actually saying? And I think it's extremely important to understand that, because at the end of the day, whatever they're saying on camera is something that you're going to ingest, you're going to analyze, and you could potentially make a very life-altering decision with that information. So first step, really understanding, is this education or is this entertainment? At Grit Capital, we like to think that we're educating our audience, we're educating our members, we're providing real information, real tangible information that can help our readers change the game and do it yourself. And with that is a very, very powerful place to be. So again, education versus entertainment. That's step number one. I'll hand it back off.
Absolutely, love it. We will go to you, Rebecca, and I apologize again. I'm sorry. I'm so sorry. At
you
Dealmaker,
can keep apologizing. I'll take it.
At Dealmaker, you have helped companies raise more than $2.3 billion from almost 2 million retail investors. What trends are you seeing in that population, and what are they getting excited about?
Yeah, so we see a ton of different types of offerings across the board. We probably have 100 live offerings at any given time, and it's companies trying to reach out to retail investors like you guys directly. The one that's been really exciting in the last 10 days, we launched the Newsmax offering. They raised $75 million, so capped out their offering in less than 7 days. So really showing you the power of retail there. People wanted to be a part of that story. And I think what you said is really interesting and important too, because we operate in the US and the regulations there give you mandatory disclosure forms. And so there is a really strong way that you can compare offering to offering. And so we're seeing people do that and really be able to make that basis of comparison and then decide what types of offerings they like. And so exactly as you were saying, a lot of our companies use StockTwits to reach out to different types of communities who have that core thesis, and then they want to play around and invest in something that's adjacent to the type of offering that they like. So strong following on robotics companies, strong followings on AI companies. Sports is an emerging category for us as we see more fan ownership model taking hold, which is popular in Europe, and we're trying to bring that into America.
And maybe a little bit of a follow-up, because you mentioned StockTwits. This is a little bit of a newer thing. Like being able to private invest 2 decades ago was extremely upper echelon, the top of the top. And so, what are some innovative and new strategies that you're seeing companies saying, hey, we want to get investors in the private markets, but we don't really know how in this new digital landscape?
Yeah, because so much of what we do is private. There's a really interesting trend of combining perks with the investment where you're making money, right? So classic offering like the Green Bay Packers, when you get to invest in that sports team, you get to go to an annual shareholders meeting and get access to information that you wouldn't otherwise get. And we've had restaurant and bar companies where if you invest over a certain amount, you can name a drink. One that I really like, one of our customers did this week, is it's a movie company, so if you invest over a certain amount, you can pitch an idea to the producers and get an opportunity to really get involved in that business. So I know even some of the earlier panels, people were talking about that concept of building community, and that's really what we're seeing social media allowing people to do, right? You can be an investor, but you can also take advantage of perks and get to make that company a part of your life and a part of what you experience, which is very cool and exciting and benefits the company. Even for me, when I started Dealmaker, my investor base were the one who started putting deals on the system, and they helped me get to revenue much quicker than I otherwise could if I had just taken a check from a VC or an institution. So people are waking up and realizing the power of the retail investor and how it can be leveraged to build new age companies better, faster, cheaper.
Great, thank you so much. Zave, let's go to you. Are you in Houston, Texas right now?
That's right. That's
Going
right.
all the
Houston,
way down
Texas.
To Houston, Texas.
89 degrees, sweating my butt off, but it's all good.
All right. Love it. So you break down financial news in a very engaging way, maybe the most engaging of all the quote-unquote finfluencers, even though we all hate that word.
Yeah.
What are the most common mistakes that you're seeing young investors making when they're interpreting market trends?
I mean, I think it's what Tom said earlier. Everyone just falls for the hot thing that's trending on TikTok, Instagram, Twitter. Back in 2020, it was SPACs. Then we got then the NFT craze, and then you got the GameStop stuff, and now it's zero-day options. It's those leveraged ETFs. Everyone just kind of falls for that because you see a video of someone turning 30,000 into 30 million, and so you do that, and you realize, oh, it's not a free ATM, and then people end up losing money. But I actually agree with what Tom said earlier. I think it's okay making mistakes, especially if you're young, and especially if you have what I like to do is, it's like an 80-20 split for me. 80% is the boring index funds, and the 20% is what I call a YOLO fund, where you can just experiment with stuff, and if that goes to zero, hopefully it doesn't go to zero, but if it does, at least you have your 80% kind of keeping you going. So people make mistakes, but I think if you're younger, it's okay to make those mistakes because you're going to learn from that, just like we all did when we were younger.
Absolutely. And I've also heard a phrase of we're all going to take losses in the market, especially today. So, but it's almost like you're paying your tuition to the market. There's very few people that have ever gone on to have $1 million and then a $10 million and then $100 million portfolio that haven't had substantial losses. If you're going to be cool with making 100K, you have to be cool with losing 50 to 100K at times, which sounds crazy to some people, but that's how it goes.
Hopefully not that much, but you got to
You know what I mean. You know what I mean.
Yeah.
So let's go to you, Robert. You have built and invested in multiple businesses across numerous industries. What key lessons from entrepreneurship would you say apply most to DIY investing?
That's a great question. I would say first and foremost, be a voracious reader and learner. So many people try to skip to the finish line but don't understand what they're investing in. That's how they get wrecked and lose their money. Number two, use platforms, people, and mentors for speed. When I came up in the world, there was no speed. You had to learn it the hard way. There is no reason to learn from your own mistakes. Use everyone else's mistakes and learn from them and use that for speed. And number three, and I think I see it a lot in the speaking engagements being all around the country, so many people come to events, they go to masterminds, they read, they follow the Rich Habits podcast, they do all this, but they don't take action. And something that I say all the time is that you have to take notes and take action, and I think that's the most important factor because so many people have it all in them to be successful financially and build their wealth, but they just don't take enough action because they're on the sidelines because of analysis paralysis or reading these headlines or the clickbait and they're not sure what to do. So those would be my 3 points.
Love it. And lastly, Mr. Hankwitz, over the last few years, DIY investors have been dealing with meme stocks, zero commission trading drama, alternative assets, and just a lot of other changes that I feel like a decade ago, that just wasn't really in the spotlight. So how do you think young investors or new investors should balance long-term investing with speculation?
I mean, we've talked about it now 2 separate times. Tom mentioned the Core Explorer. Zaid had sort of double-clicked on it, and my phrase on it is the Core Satellite Portfolio Strategy. How do you, to Zaid's point, there's nothing more fun than learning about something new, like a meme stock or a zero-day option expiration date ETF or a leverage ETF and wanted to try it. I think everyone needs to your point, pay their tuition to the market and try something, but because if we don't do that, we then fall for those big 100K losses because I gambled away the other 80% of my portfolio that wasn't supposed to be allocated to that. How I really encourage as many people as possible to balance risky investing with normal investing is it's called a core satellite portfolio strategy. 65 to 80% of your portfolio is the blue chip index funds and ETFs like the S&P 500 or the NASDAQ and all the big boring things. And let's call it the other 25, 35% or whatever that can be into these more high octane, high growth, blue chip still ideas, but you're not exactly gambling. You're still doing your analysis. You're still putting in the effort. You're still learning from people, like to what Robert's point, right? You're learning from people around you and doing things in a way that balances the I'm young, I can be aggressive and risky, with the I'm also cognizant that I want to be wealthy when I'm older, so I can't roll the dice every single time a new opportunity comes.
Absolutely. Well, thank you all so much. Thank you, Zaid, for tuning in from Houston. And, I just feel like when we were planning out this whole day, we really wanted this to be a panel we were talking about because I think something Jen had said to me is like, this is not your grandmother's market. Like, this is a crazy stock market. The DIY investing is no joke. If you're just to set it and forget it, few $100 in ETFs, that's great. But like the temptation has never been there more. We got Newsmax going up 1,900% in a day. Most people don't know what Newsmax is. And Tesla can be down 10% and up 10% in the same morning. It's chaotic. So that's why I feel like at Grid Capital, we're doing a good job of cutting through that noise and follow along for all the people that were on this panel because they're doing a great job of it too. So thank you.
Thanks, everyone.
Best panel of the day.
Yep.
Cody Sanchez apologizes she can't be here live with us today. She had a scheduling conflict, but we did have a fireside chat with her, and we're going to now play 10 minutes of that chat for you to watch.
Investor and best-selling author of Main Street Millionaire, an instant New York Times bestseller. She's the founder and CEO of Contrarian Thinking, one of the fastest growing financial media platforms with 6 million followers and 100 million monthly views. She's also the founder of Contrarian Thinking Capital and Main Street Holding Company, which invests in small cash flowing businesses. Think car washes, laundromats, property management companies. She's also got a finance background, having worked at Goldman Sachs, State Street, and Vanguard. Let's dive in. I just loved your book, I have to say. I literally read it in 24 hours. Last weekend, I just stayed home and I was like, I'm going to get through this thing because I want to be fresh when I talk to you. So,
well, thanks. I'm so glad you liked it because you know what it's like. Like, one, being a woman on the internet is so weird. And then two, being a woman who's ever invested in anything, they all assume we're secretaries. And then three, you have to simplify it for the masses, but you also don't want to insult the intelligence of your smart friends and people who are reading the book. So it was a real, when you come out with yours, I'm happy to share anything that you're struggling with at the time, but I was like, gosh, it's hard. How do you write it like really clean, but not condescending?
Yeah, exactly. You've got many goals going at the same time, and that must be difficult. But I obviously, because it's a New York Times instant bestseller, you nailed it.
Thanks.
You got it done. And I was reading it, and I was thinking to myself, like, one of the things that's always drawn me to you, and we originally connected on Twitter with X, and had a few phone calls over the years and everything. But this is our first fireside chat. Was that you've always pushed the boring is the way to go, right? So you buy boring cash flowing businesses. I invest in publicly traded boring businesses. So I've always been a fan of the storage, the waste management, the cemeteries even, and some logistics. And so when I read the book, I was like, this is just perfect because it aligns with my philosophy and it just reconfirms everything. But also, I just bought a boring cash flowing business myself.
Wait, what? What'd you buy?
So I bought my family
family's wealth management business. So
also a great business, by the way. Recurring revenue, LTV of $1 billion per customer. That's a great business.
Yeah. And like the application of a lot of things you mentioned in here, like getting an operator, the first like 120 days are super key. All these things apply. So I was just like eating it up as I go. But in terms of like diving in, so we've got, over 300 people in the audience here, and we wish you were here in person with us, but, busy schedules. I think one of the things that's on kind of everybody's mind, right, is how do you go from employee to entrepreneur? So like for you, what was that moment that made you say, I'm done being an employee and I'm going to go all in? Like what made you do it?
If you are an employee right now, what I'd say is like, start small. Everybody else tells you the opposite. Everybody else says, quit your job, go find the thing you love, go all in. And I'm the opposite. I'm here to tell you it is perfectly fine, no matter where you are and no matter how small you start to start. And I will make that case for you every single time. We just came out with a YouTube video where we bought a couple vending machines. We put them in different spots across the city and we saw how much money we could make. Because I want to make a couple $100 per vending machine per month? No. But why? Because that is a gateway drug to business overall. And there is no real difference. You still have a business, whether your business makes a couple $1,000s, hundreds of thousands, or hundreds of millions. And so what I would say is start. I like starting small because if you start small, one, it's not scary. You don't go to the gym and try to lift 400 pounds. You go to the gym and you start and you do a couple dumbbell curls, or you're like me and you continue doing that for most of the time that you've been in the gym. And then, you can scale up. And so I think it's the same way with being an entrepreneur. The difference is that I like people to try to buy instead of build. I think you buy, then eventually you can build as you go. And so there's so many businesses, and Canada is a great example. Canada has a higher percentage of small businesses as a percentage of their citizens than the US. And so all around you in Canada today are small businesses with the same aging population demographics as the US, looking for somebody else to come in and take them over. And it does take skill, definitely does, to do that, but they are all around you. So no matter what, like next time you go into a small business, start getting to know the owners, start getting to understand what somebody's P&L looks like on a small business. And eventually you will have a business slapped in your face, like kind of like it sounds like you did. You won't be looking for it online. You won't be searching all around. You'll be like, Tom's mom wants to sell that business and I'm an accountant and she owns an accounting firm. I could probably buy that. And I wish more of us would think this way.
Yeah. And one of the things you just said is it's not a startup, right? So everybody thinks, oh my God, let's get into the Silicon Valley scene and get, become the next unicorn. And we obviously know that those have huge failure rates. So that's a fatal flaw in the startup mentality, right? Whereas cash flowing, you've got the history, you've got the longevity, you've got the dependency of that cash flow stream. And so it makes it so much more appealing. The other thing I love that you talk about is that there's no wrong business. There's just the right one for you. So you really have to know thyself. Like that is a key thing before you go into business. And I know that during COVID, when I was in between businesses, I almost tried to start a glamping company.
Oh, Lord.
And yeah, because how everybody was going like luxury glamping. But I realized when I went to a property and I was talking about where's the sewage tank going to go? And I realized that a lot of my life was going to have to do with sewage. I was like, you know what? Not for me. So
for you.
I realized right away.
Well, it's a good point because we have something in the book called the perfect fit business, kind of like these Venn diagrams between what you're good at, what you want, what you're obsessed with, who you know, and the business that's right for you. And so I think everybody has that. Now, your first business, maybe you're not skilled enough to know. When I first started out, I was like, you know what I am passionate about? It's called money in my pocket each day. That would be great. Like, however it's there, if it's legal, I'm in. And that might be where you're at. And for some people listening, you might be like, I have a whole list of what not to do. I think one of the great ways to start a business was to start with a what not to do list. And so in my acquisition strategy, for instance, I almost bought a tooth repair, a fake tooth implant company in Chicago. And then, no offense to the Canadians, but I went to Chicago in the winter because there was something going wrong with the transaction we were going to do. And I was like, I'm out. I don't want to have to come here in the winter often. It was in the suburbs. It was like icy. I was like, you know what? Okay. One of my not to do's is if I'm going to have to operate this business, I don't want to do it in a climate that's cold that I don't want to have to go to in the winter. I don't like the cold really. So that was one of mine. Super weird and random. Yours might be, I don't want to deal with sewage. Mine might be that it has to be a business that's XYZ size or it's not big enough. And so starting with your not to do list is really, really useful. And I think a lot of times we can't tell what we want. We're just mimetic desire machines. You want what you want because you saw somebody else have that thing. And it takes you getting it to realize, oh, that's not what I actually wanted. And so starting starting with all the things that would be a no for you is really helpful in acquisition, I think.
Love that. Another thing that you talk about is grit. So owning a business is 10% the business you buy, 10% knowledge, 10% talent, and 70% don't effing stop, right? So grit is a huge component. And so my question to you would be, and I don't know this, I mean, my previous company is called Grit, so I think I've got it, but how many people have it? And is it something, if you don't have it, that you can actually develop over time? Or is it just like, maybe it's not for some people?
I truly believe that anyone can build and buy a business. Anyone can. It's really not an aptitude thing. And they seem to show that grit is actually teachable, that you can learn to have a higher attention allowance that you can actually build to. And so, for instance, I guess I think about it a little bit like weightlifting.
Avoiding costly mistakes. I love this opening line that you had that your father once told you. You aren't truly in the game unless you find yourself in the dead of night, head in hand, sitting in the dark with no idea what to do next. So I think you found yourself in one of those situations on one of your big cannabis deals. I think that on the due diligence side, there was, big lessons learned. So I'd love to share that with the audience.
I always chuckle when I post that because my friends who are entrepreneurs will always respond with just one night in the dark because we know that's not true. Different levels, bigger devils. And so there's always going to be the next hard in front of you. And that's just you unlocking the game of business and realizing, now I'm on this next level of the game. I'm not quite equipped for it. I got to get better so my business can get bigger, because you are usually the biggest obstacle to your business growing. I realize that about myself all the time. Anyway, in that particular deal, that was when we had an investment. I think we did like $25 million in an individual company, and we did all the financial analysis. We did the due diligence. The business was a very strong retail business, and the one thing we missed is that there was massive fraud inside the business, collusion among the accounting firm, the bank, and the individual who was running it. And so they essentially defrauded us, had the books sort of cooked, and we found that out in 1 week, and then had to send out our turnaround guys to go see what we could fix over the weekend. And thankfully, we used a couple of tools that are important for you to know if you ever run a business, namely a 13-week rolling cash flow. I still use that in my businesses today, which, a lot of people are like, this isn't a standard P&L. And I'm like, that's because I have PTSD. So I remember when we almost lost this deal, and I like to see where my cash is. So it's one of the first things we teach in the scaling workshops. There's like, okay, here's your cash. Like, money's a cruel mistress. If you don't pay attention to her, she'll leave you for somebody else that does. What's happening with your money? And so we put the whole business on a 13-week rolling cash flow. We did something called zero-based budgeting, all about this. So we basically said, not what can we cut, but starting from the very beginning, what do we actually need inside of this business? And we're going to cut everything we can't think of as an absolute need. And eventually we turned that business around. But what it taught me is that you need to trust but verify, the old Russian proverb. You almost have to assume always that even though the business owner might not be defrauding you, that they could be lying to themselves too. And so you're always checking for the lie in financials to make sure that even optimism can lie to you.
Cody, amazing. Great to have you here. Great book. I can't wait for the sequel too. I know this is going to be a series for sure. Yeah,
well, thank you for having me. And thank you for creating so many builders up in Canada. It really, we have a saying here called Owner Nation, which is that we believe that all across this country, we started as owners in America, and that's true around the world. We all started owning our own businesses, then having apprentices, then handing them down to our kids. And I think it's time that we got back to getting a little ownership and skin in the game. And so I think it's awesome you put together this group for a bunch of humans who are trying to be builders in a world of burn it downers. So thanks for having me.
Build. Love it, love it, love it. All right, Cody, thank you so much.
Thanks, Genevieve.
Okay, last but not least, we have our keynote here. He's an inspirational author and entrepreneur. He captivates over 800,000 people per week through his social insights newsletter called The Curiosity Chronicle. His first ever nonfiction book, The 5 Types of Wealth, hit the shelves on February 4th, 2025, and it became an instant New York Times bestseller. He sold over 200,000 copies, and the book has been endorsed by Bill Ackman and Tim Cook. If you don't know who he is, we've got a video to show you who he is. So let's cue the video.
You cannot work smart before you work hard. because you have no idea what to work smart on. When you're young, the only asset you have is time. It is the only asset you have. You don't have networks, you don't have money, you don't have knowledge, you don't have experience, you don't have wisdom. You don't have any of those things. You have time. So what you need to do is you invest your time to gain knowledge, networks, money, wisdom, experience.
Your life doesn't change in a day, but if you slowly change your days, you will eventually change your life. Tiny actions are what create the momentum to actually go and create these enormous changes. So just start small.
The question that I ask in the book is, would you trade lives with Warren Buffett? And Warren Buffett has $130-ish billion. And I'm willing to bet none of you guys would trade lives with him. One, because he's 95 years old. And you certainly wouldn't want to trade the amount of time he has left on the planet for the amount of time you have left. Anything above zero compounds. We know that financially, right? Like we know that if we put away $10, that's better than putting away zero. The exact same thing applies to all of these areas of your life. So if you can just convince yourself on those bad days to just do something, it's better than doing nothing.
Sahil Bloom.
Woo! Can you hear me? Oh, that was quite a hype reel. I hadn't seen that one yet. That was pretty cool. Thank you.
Yeah, Austin,
yeah.
Austin made it, right?
No, I did not. I did not make that. But I wish I could take the flowers for it. It's pretty cool. I agree. It's pretty cool. You've done some really cool things. There's a lot of things to hype you up on.
Yeah, and let's get right into it. Let's get right on the ground floor. So, I selfishly am super hyped to have you here because I, in the last 3 months, have neglected every other type of wealth except for the financial one. And I have been working basically 10-hour days, 7 days a week for 3 months straight. I took on a new role as president of my family's wealth management company, and I had an eye-opening wake-up call. And I know that you did as well. I know that in 2021, after pursuing a pretty narrow path yourself, getting the big job, getting the big numbers on your paycheck, the cars, the house, everything, you also hit a point where it wasn't fulfilling. You weren't happy with the direction of your life. And here you are, 4 years later, and obviously the decisions that you've taken since have led to a much better outcome for yourself. So could you share with us what that wake-up call looked like, and how did we end up on this stage here?
Yeah. I had spent the first 30 years of my life very much chasing the definition of success that you are told is the one that counts, the one that matters. Get the job, make the money, do the things, climb the mountain that society tells you is the mountain that you should want to climb. A lot of that, if I'm going to be totally honest, was grounded in an insecurity that I had from a young age, a feeling that I wasn't very smart. I grew up in a very academically oriented household. My father's a professor at Harvard. My mother is Indian. So for anyone that has immigrant parents, academic success in the family was really the measurement of achievement. And my older sister was highly competent academically. And from a young age, I convinced myself that she was the smart one and I was not. And so I chased anything else that I could possibly find that would tell me that I was good, that I was enough. And the way that we typically do that in society, when you have any sort of internal insecurity or void, is you go and search for any external affirmation that you can find. And the fastest way to go and do that is to make money, to go get a job that sounds impressive. The single best piece of career advice I have since received, I wish I had received it earlier, was asking yourself the question, do I actually want this job, or do I want other people to see me having this job? It's a really important difference between the two things there. There are a lot of things that we go and pursue because we want other people to see us having that thing, not because we actually want to do it. And my early career years were exactly that. I went and took the job that I wanted other people to see me having, an impressive sounding job. And I did well at that game. I was able to chew glass in my own way to rise through the ranks within that industry. And in a lot of ways, those early years of your career and of your life are defined by coming up Maslow's hierarchy of needs, right? You're trying to achieve basic financial foundation so that you can take care of the people around you, get basic pleasures, food, shelter, first vacations, take care of people. But after that, we've all started to feel at different points that there are other things, that the diminishing returns start to set in, if you will. And unfortunately, in my own life, I got so narrowly focused on the one thing of making money, of accumulating status, of getting these things, that I started to lose sight of everything else. Most importantly, my relationships. I was living 3,000 miles away from my parents, who were getting much older. I wasn't seeing them often. My relationship with my sister had effectively ground to a halt, and my relationship with my wife was strained. We were struggling to conceive at the time, had been for about 2 years. I was drinking 6-7 nights a week. My mental and physical health were suffering. All of these other areas of my life had started to suffer, while on the outside looking in, it looked like I was winning the game. And in 2021, early 2021, I started to have this sensation that if that was what winning felt like, I had to be playing the wrong game. And it all came to a head for me in a single conversation in May of 2021. I went out for a drink with an old friend. We sat down, and he asked how I was doing. And I told him that it had started to get difficult living so far away from my parents, who were on the East Coast. We were 3,000 miles away. I had started to notice for the first time in my entire life that they were slowing down, that they weren't going to be around forever. And my friend asked how old they were. And I said mid-60s. And he asked how often I saw them. And I admitted that it had gotten to the point where it was about once a year. And he just looked at me and said, okay, so you're going to see your parents 15 more times before they die. And I just remember feeling like I had been punched in the gut. The idea that the amount of time you have left with the people that you care about most in the world is that finite and countable, that you can literally put it onto a few hands, had just shaken me to the core. And in that moment, I realized that my entire definition of success, of what it meant to build a wealthy life, was incomplete. I had been focusing on the one thing at the expense of everything else. I was winning the battle, but on the path to losing the much bigger war. And that was when we decided to make a change. The next day, my wife and I had a very candid conversation about what we wanted to build our life around, what our center really was. And within 45 days, I had left my job, we had sold our house in California, and we had moved 3,000 miles across the country to live closer to both of our sets of parents. And in that one decision, there was a very important realization, which was you are in much more control of your time than you think. That number, 15 more times before they were gone, is now in the hundreds. I see my parents multiple times a month. They're a huge part of my son, their grandson's life. We had taken an action and created time for the things that we really cared about, moments with the people that we really cared about. That was the spark that changed everything, and that was the spark that ultimately led to this idea to put this book out into the world.
That's powerful. That's very powerful. In your book, you talk about something that you dub anti-goals. So I would imagine over the last handful of years now that you've been on this journey of becoming the best version of yourself that respects the 5 different types of wealth, you've had some anti-goal relationships, and you're looking around like, that's definitely an anti-goal. So explain to everyone listening, what is an anti-goal, and how are you able to sort of navigate them?
So Charlie Munger, who everyone in this room is familiar with, has this famous quote, "All I want to know is where I'm going to die, so I'll never go there." That idea is basically anti-goals in a nutshell. It is to identify where you are going to die, metaphorically, so that you never go there. Anti-goals are the things that we don't want to happen on the path to achieving our goals. We all know what goals are. At the beginning of every year, we set out what the summit is for that year in our personal and our professional lives and whatever it is that we're doing. We know what a goal is. We all know how to set goals. Anti-goals are really important, because sometimes in your pursuit of marching towards these goals, you lose sight of the fact that a lot of other areas are starting to suffer. You get so narrowly focused on the one thing, like I had in my life, that the other things start to fall apart. So if you think of goals as the summit of the mountain, anti-goals are the things that you are not willing to sacrifice in reaching it, like your toes or your life if you're climbing a mountain. Anti-goals are the things that most people need to focus on more, because it doesn't take much to find examples of people who have won the battle but lost the war. It's called the Pyrrhic victory. It's a victory that comes at such a steep cost to the victor that it might as well have been a defeat. We don't have to look far to find examples of that, people that we know. As a society, we write books about these people, right? There are billionaires out there, centimillionaires. We celebrate and admire these people. We pat them on the back. We tell them that they won the game. And we ignore the fact that they have 3 ex-wives and 4 kids that don't talk to them. And we pat that person on the back. We write books about that person and say that they won the game. And you all have to ask yourself in your own life, is that actually a game that I care to win? Does that look like winning the war? The war is about building a fulfilling life. One of the battles in that war is making money. It is building something of value. But that is just one battle in a much bigger picture war. And sometimes you can focus so narrowly on one that you lose the bigger picture. Anti-goals and setting those along the way is how you avoid that fate. It's how you avoid going to the place where you're going to die.
And real quick, before we go further, in case people here haven't read the book, do you mind explaining the 5 types of wealth? And like, what is that? Walk us everyone through that.
So the 5 types of wealth that I cover in the book. Time wealth is the first. Relates to the story that I told about my family. Time wealth is about freedom to choose how you are spending your time, who you're spending it with, where you're spending it, when you're trading it for other things. It is fundamentally about an awareness of time as your most precious asset, the one thing that you cannot get back. Social wealth is the second type. This is about your relationships, the few close, deep bonds, and then the looser connections to things that extend beyond the self, communities, local, regional, spiritual, etc. Mental wealth is the third type. This is about purpose. It's about growth, and it's about creating the space necessary to wrestle with some of the bigger, more unanswerable questions of life, whether through religion, solitude, spirituality, meditation, etc. The fourth type is physical wealth. Physical wealth is about your health and vitality, taking the daily controllable actions to fight against the natural decay that your body will go through as you get older. And then the fifth type is financial wealth, money, what we all know, with the specific nuance of really focusing on what your definition is of enough. The acknowledgement there being expectations are your single greatest financial liability. If your expectations grow faster than your assets, you will never feel wealthy. You will just be chasing whatever more the world has told you you should want.
And on that, so let's say you've decided, okay, I want to focus on my social wealth. Say you've neglected that. You've neglected your friendships. You've neglected your social circles. And you've got this goal in mind. Okay, a year from now, I'm going to be, being invited to XYZ events at all times, and I'm just going to be thriving, and the invites are going to be coming in. But you don't actually do anything beyond maybe reading your book or reading Atomic Habits. And so you've talked about this concept, I've seen you interviewed on this, about basically kind of dopamine consumption. So you're consuming, you're reading, you're understanding, but you're not actually making any moves in your life to change the outcome because you're just thinking about it. You're not doing the doing. So in, famous words of one of my idols, Richard Branson, who wrote a book called Screw It, Just Do It, how do we get people to move out of that inertia stage and start actually moving into action?
Well, you're absolutely right that dopamine from information gathering is a very dangerous drug. That is the dopamine that you get when you read Atomic Habits and you say to yourself, oh, I'm good at habits now. I'm a habit guy now. But you haven't done anything yet. You haven't gone and actually acted on the ideas or the information. What you find consistently across looking at the most successful people in the world is that they have a razor-thin gap between information and action. They gather new information, but then they're immediately acting on that in some tiny way. That doesn't mean dramatic action, but there's some tiny action against that information. Most of us have a gap a mile wide. We're gathering a lot of information. And by the way, I'm speaking to myself here. All the time, gather information, get the dopamine hit from that, never take the action against it. Part of that is because of fear. We are all afraid of different new actions. One of the recognitions there is to recognize that your fear comes from inexperience, not incapability. We have a tendency to believe when we feel fearful before starting something new that we are incapable of doing the thing. It's much more about the fact that you have not done it yet. Inexperience is the problem to be solved, not incapability. And the only way that you solve inexperience is by having the courage to start, to go and do the thing, to recognize that the people that you admire in life are just people who had the courage to get started. They didn't fear the embarrassment of being a beginner. They didn't have that hold up. They didn't overthink it. They just got started in some tiny way. So in all of these areas that I talk about, no matter what the type of wealth is that you feel deficient in or that you're trying to focus on, the entire rule is to just do some tiny thing. I say this in the book. I have this concept of dimmer switches in life. The traditional wisdom in your life in all of these areas is to say that they exist on on-off switches. So if you're going to focus on one, let's say early in my career, I'm focusing on financial wealth. Okay, that switch is turned on. And you say, too bad health flipped off. Too bad family, friends turned off. I'm going to focus on this one thing. The problem with that mentality is it is dangerous because for many of these areas of your life, if you turn them off and they stay off for too long, you can never turn them back on, or they become very difficult to. If you don't invest in your health in your 20s, 30s, and 40s, it will not be there for you in your 50s and 60s. Relationships, if you don't invest in your relationships with the people that you care about, if you're not there for them during their times of need, they will not be there for you during yours later in life. In all of these areas of life, we need to treat them like dimmer switches. Just because you're focused on the one doesn't mean you turn the others off. They can just be turned down low. The recognition there is going to draw upon something that you innately understand in your financial life, which is that anything above zero compounds. Putting away $50 is better than zero because it's going to stack and compound into your future. We know that when it comes to our money, but the exact same thing applies to all of these areas of your life. Sending the text to the friend when you're thinking about them is better than doing nothing. Calling your parents for 2 minutes that you have during your commute is better than doing nothing. Going for the 15-minute walk is better than doing nothing. But what ambitious people do in our minds is we allow optimal to get in the way of beneficial. Over and over again, you can find examples of this in your own life. You say to yourself, I don't have an hour to work out, so I'm just not going to work out today. Oh, I don't have 2 hours for deep work, so I'm just not going to do that. I'm just going to email instead. I don't have 30 minutes to call that friend, so I'm not even going to send the text. Over and over and over again, we do that. And when you're doing that, you're allowing optimal to get in the way of beneficial. What we need to realize is anything above zero compounds. Do the tiny thing, the dimmer switch down low, and you allow those things to continue to compound and progress in your life. All of this is to say, we need to stop saying later when it comes to our lives. Later is the most dangerous word in the dictionary. We say it over and over and over again. We say, I'll spend more time with my kids later. I'll focus on my relationship with my partner, with my friends later. I'll focus on my health later. I'll find freedom and purpose later. The sad thing is that later just becomes another word for never, because those things are not going to exist in the same way later. Your kids are not going to be 5 years old later. Your partner, your friends, they won't be there for you later if you're not there for them right now. You won't magically wake up with freedom and purpose later. So either you find a way to design a tiny incremental investment on a daily basis into these areas now, or you're just going to end up regretting it later.
Something you mentioned there for a moment was, excuse me, I'll spend time with my kids later. There's a friend of the audience, his name's Nicholas Brado, just figured out he's having a baby boy, really excited for him. And so something you talk about, yeah, congrats, man. Something you talk about, though, in the book is like these magical years, right, with your children. Can you further explain that?
The ancient Greeks had two different words for time. They had chronos, which is this idea of chronological linear time, time A to time B, how you think about time. All time is created equal. And then there was kairos, which is the idea that not all time is created equal, that there are specific moments, specific windows of time that actually have more importance. They have more meaning. They have more texture. That is what you're bringing to life when you think about these windows with certain people in your life. 95% of the time you have with your kids is over by the time they turn 18 years old. 75% of it is gone by the time they turn 12. And yet, we live in a world where those 10 to 15 years are the time when you are told to hustle until you drop. That is the window of time when you are told you should be chasing every single more that the world has told you you should want. And so the call to action around all of this is to actually question these things. It's not to turn off your ambition and to say, oh, well, I'm just going to stay at home and be at home all the time, because we know that's not reality. The reality is you're going to find your own harmony. But what I want people to do is question the assumption. Question whether or not you need to be chasing every single more. Is that actually a mountain that you want to climb? Or is it just one you've been handed that you've assumed, oh, okay, I should do this. Yeah, this is what people do. We do this, then we get on the partner track and we want to go and do these things. Is that actually a mountain that you care to climb? Is that a race that you really care to run, or are you just accepting it by default? We need to find our own balance across these different tensions of life. The tension with children is between presence and ambition. Presence is the desire to be there during those 10 years, those 15 years that are truly magical. Ambition is the things that you are trying to build, the things that you want to go out and do, the value that you believe you can go out and create in the world. Finding your own ability to navigate that tension and that balance, that is where your best life is going to be built. And it's going to be built through you actually confronting and asking the question, not just accepting an answer by default.
I love this quote in your book. Some people die at 25 and they aren't buried until 75. So why is it important to remain curious about the world, and why is it so difficult for people to do that as they age? What are we fighting psychologically and physiologically that's preventing us from doing that? How do we break free from it?
Scientifically, curiosity, if you could bottle it up into a pill, would be like a super drug. All of the pharma companies around the world would clamor to sell you the curiosity pill, because scientifically it improves all-cause mortality. You see all sorts of benefits to your purpose, to your life, to your health, to your happiness. All of these things come on the back of curiosity. And fortunately, curiosity is in our default setting. Anyone that has children, young children, know that children are born with an innate curiosity for the world. It's how we learn about the world around us. Now, if you were to think about in your own life how often you pursue your own curiosities, I would guess if you were to map it over the course of your life, it looks something like this, just a steady decline. I would argue that the biggest reason for that is because of a lack of space in our life to actually pursue those things. How much time do you really have to pursue your curiosities? When you get curious about something, compare it to your kid. I have a 2.5-year-old at home. If he gets curious about some worm or something that he finds, he can go spend the entire afternoon playing with a worm and learn. If I'm around, I'll teach him about. We can go Google. We can look stuff up. We can spend time thinking about worms. As an adult, if you get curious about something, it's sort of like, oh, I'm curious about this. Oh, too bad. I got to go do emails. I got to go send these invoices. I got to go take care of my kids. I got to go take the trash out. There's a million things, all this stimulus coming in, and the response that we have to urgently do to those things. So we squeeze the space out of our lives to actually pursue that curiosity. And as a result, we stop living with that innate curiosity. We give up on it. One of the really important actions that you can take in your own life to improve it is to create little pockets of space. You may use that space to pursue your curiosity. You may use that space to just zoom out and ask some of these bigger picture questions. You may use that space to just breathe, to just give yourself a little bit of a break that we very rarely get. But that space is where you find a lot of power. Viktor Frankl famously wrote that our power as humans exists in the space that we can create between stimulus and response, because in that space is your power to actually choose your response. That is a really important notion, and one that we can all adopt into our lives. It could be a 5-minute break in between meetings. It could be an hour once a month where you get yourself to a coffee shop, get out of your normal environment, and just think. But we need to create more space in our life if we can hope to embrace more curiosity.
Something else you talked about in your book, Beyond Curiosity, has to do with this idea of a life raiser, right? This sort of non-negotiable is kind of how I like to think about it. Can you explain what a life raiser is, and then, of course, include the example of the Netflix CEO and sort of how he approached his life raiser, accomplished everything they did as a business while still respecting what that decision was?
So I spent time during the book research process with a man named Mark Randolph, who is the co-founder and first CEO of Netflix. And Mark had written this little short essay, maybe 3-4 years ago, that he published entitled My Definition of Success. And what he talked about in it was that throughout his entire technology career, he had this hard rule that at 5 p.m. on every Tuesday, he would leave work to have a date with his wife. And he talks about the fact that what he's most proud of from his career is not the companies that he started, the enterprise value that he created, the jobs he created, or any of those things, or the money that he made. It's that he was able to do all of that while still remaining married to the same woman and having children who, as far as he knows, still like him. He said that, as far as he knows. That idea, after spending time with him, what I realized as I was reflecting on it, is that the dinner and the actual action of it had really nothing to do with the date. It had nothing to do with any one dinner, the 5 p.m., any of those things. What it was a single identity-defining rule for his life. A single statement, a single powerful action that defines how he shows up as his ideal self in all of these other areas. It signals to the world that he created these boundaries, that he really embraces family and his relationships as the center of his world. That empowers other people around him on his teams to do the same. It lets his family and friends know where they sit within his world. It was very representative of the type of person that he truly believed he was. That idea is what I summarize in the book as building your own life raiser, a single rule of thumb that allows you to cut through the noise at different stages of your life, to be able to say, what does the type of person who never misses a Tuesday dinner do in this situation? My life raiser, as I define it in the book, is that I will coach my son's sports teams. He's 2.5 years old, so he's not on any sports teams right now. So it is much more about how I define myself, what type of father, the type of husband that I want to be as my ideal self. So when an opportunity comes up that might require me to travel 200 nights out of the year, there's no amount of money that you could pay me to do that. And I truly mean that, because I can say to myself, what does the type of person who coaches his son's sports teams do in this situation? Well, I have to prioritize being present. I have to prioritize being the type of father and the type of husband, the type of community member who is there, who is in the weeds, in the trenches with these people that I care about. Creating your own version of that life raiser, I would argue, is one of the most powerful things you can do, to allow you to cut through the noise when you do have those different moments of chaos, those moments of opportunity that come up within your world.
And on that note, the North Star, I guess you could call it, your life raiser. You wrote a letter to yourself, and you published it in the book. You wrote it 10 years ago in 2014 when you had just graduated. And you put a bunch of things in there that you hoped would come true. And you were amazed when you found this letter that, in fact, a lot of them had come true. So I'm wondering why you think that this worked and how people in the audience could maybe use this strategy for themselves.
Ever since I was a kid, my grandmother, my mom's mother in Bangalore, India, used to have us do this annual ritual. At the end of the year, right around the holidays, we would go and visit, and she would have us write a letter to our future self. And she would give it to us the next year. So it was this 1-year annual ritual that we would do. We would write these letters, and the next year we would open it and see, what we had written, how we had grown, how we had changed. And I always loved the practice. It was something that kind of my whole family bonded around. Then we did it when I was in school, maybe when I was going into high school. We wrote a letter to our future selves, and they mailed it to us after we graduated high school. And I remember thinking that was really cool. And a lot of the things in that letter had come true. And so it started to cement in my mind as this thing, okay, I might make a practice out of this. So when I was graduating college, I wrote this letter to my future self. And the whole idea was it was going to be 10 years in the future. I'd never done that before. Totally honestly, I forgot that the letter existed. I put it into this little personal safe that I had, completely forgot about it for 7-8 years. And then after my son was born, we were doing some documents for our will, and I opened the safe to put documents in there, and I saw the letter. I had never opened the safe otherwise. There was no use for it. And I found the letter, and it said to open it on January 1st, 2024, which just so happened to be about a week before I was due to turn in the final draft of the book. I opened the letter and read it, and it was mind-blowing because the most important thing that it uncovered was that a lot of the answers were already within me when I was as stupid and as arrogant as I possibly could have been at age 23 coming out of college. I mean, I was in a deep hole of insecurity. I wrote that in the letter, actually, chasing a whole lot of things. I knew all of these things that I had come to actually act upon later. It had taken me 10 years to actually go out and ask these questions and go and act upon these things in my life, but the answers were already within me. And what that instilled in me was this real understanding that for everyone out there, the answers for your own life are already within you. You just haven't asked the right questions yet to uncover and act on them. And so the whole book, the entire premise of the book, is to actually go and sit with those questions, to ask the questions, the important questions that you avoid in your own life, so that you can go and uncover and act on the answers for you. Because the truth is that no one else has the answers for your life. My biggest lamentation about the entire self-help category is that it's all about answers. I'm going to tell you the exact answers for your life. Here's the only way you can eat, or the only way to make money, or the only way to, build relationships, or whatever it is. This entire book is about questions. It's about sitting with the questions so that you can uncover the answers for your life. The answers you seek are found in the questions that you avoid. We avoid questions that are going to challenge us. We avoid questions that are going to make us feel uncomfortable. But those are the questions that we need to be asking if we hope to achieve the growth that we're looking for in these areas of life.
And I think that's a perfect segue to get the audience to ask questions. So we're going to ask the amazing TIFF team to go up and down the aisle, and you can ask Sahil anything you want, even if you haven't read the book.
I know y'all got questions.
We have a curious audience. There's one on the top left. Mike, coming to you.
First of all, great talk. Thank you so much. My question is, early in your career, early in your age, I just graduated out of school, been working for the couple of years. How do you make a decision based on taking risks and prioritizing, let's say, learning and growth over maybe a more stable salary or maybe the safe options?
I am a big believer in this concept of, two-way doors. Jeff Bezos talked about this at one point, that most decisions are two-way doors, meaning you can walk through them, and then if you don't like what you see on the other side, you can turn around and walk back. I think the vast majority of us have this mindset that if we do the risky thing, if we bet on ourselves in some way, if we go down that path, we're never going to be able to go back to the safe thing. I know when I was leaving my safe, I was on a very safe path. I was very much on a trajectory. I had this belief that if I stepped off that to do my own thing, that if it didn't work out after a year or two, I was toast. I honestly thought that I would be cooked. That I was I would have made a terrible mistake. I had a mentor actually who told me when I was making the decision, this will either work out or it will be the worst decision that you've ever made. He truly did not believe that there was any shades of gray in between the two things. That's just not reality. The way that the world actually works is you can go and experiment with things, and if you decide that it wasn't the path for you, you can go back and get that job at Deloitte or wherever the place was, the safe job that you had before. Those places will take you back, and you'll be more interesting for the fact that you just went and did something entrepreneurial that you learned. I think that more of us in our early years need to treat real-world experiences as our MBA, if you will. When I was leaving, a different mentor, who I actually found valuable, shared basically that I should treat it like my real-world MBA.
Go spend 2 years really in the trenches on this thing. And if it doesn't work out, you go back and you'll have this interesting set of experiences and you can go join another investment firm. You didn't magically lose the skills that made you a valuable employee. If anything, you will have gone and built an even more impressive network. I think that all those early years really do is start to build those kind of those core assets that you are going to then leverage later in your life. Actually, during that hype reel, there was a clip of me talking about this truth in my mind, which is that early in your career, all you have is time. You have nothing else, right? You don't have the networks, the money, the knowledge, the experience, the wisdom, any of those things. You have time. And so what you're trying to do in those early years is trade that time for those things. Once you have those things, they can be deployed into the most interesting asymmetric opportunities. But before you have them, you can't do that. You just have to trade time to get those. So the framework that I would have in my mind as you're thinking about what's next, what the risky opportunity is, what it could look like is it going to help me convert my time into those really valuable assets? And that asset sometimes is financial, but a lot of the times it's the most asymmetric assets you can develop are relationships or experiences, knowledge, networks. Those are the things that end up being the creators of the 10 or 100x opportunities. It's very rarely the extra $10,000 that fundamentally changes your life. And that's a terrible decision most people make. They take the job that gives them an extra $10,000 of salary, not the job that's going to be surrounded by people that are encouraging you to think bigger, pushing you, investing in your future.
I think we have time for one. Oh.
Sorry, never mind. I was just going to say thank you.
Okay.
Thank you. Great question.
I think we have time for one more quick question, and then we got to wrap it up. So do we have one there on the edge? Okay.
Am I on?
Yeah.
100 years or so ago, a reporter asked J.D. Rockefeller, you've got all this money, how much is enough? And his answer was, just a little bit more.
I quote that in the book. I love it.
Oh, do you? Well,
That's great.
I gave the book to my daughter, so I didn't get to it. So what happens when you get overlapping or maybe even conflicting or a conflict of these goals, i.e. money as opposed to time or mental well-being? Obviously, the little bit more represented some sort of mental joy to Rockefeller. It really wasn't the money. It was, this mental wealth. So,
well, I think that the important thing with considering anyone else's map of reality is to recognize that trying to apply other people's maps to our terrain never makes any sense. And over again, that's what we do when we compare our lives to other people. We go on social media and we look at other people's lives and we try to compare what they're doing to what we're doing, or we try to compare what we're doing to what they're doing. And we say, like, people constantly talk about this guy, Brian Johnson, the guy that's trying to live forever, right? Oh, he must be miserable. He's doing all this. Like, he can't possibly have a good, he hates what he's doing. He must hate his life. I've spent time with the guy. He's weird, but he loves what he's doing. He's just quirky. He has an entirely different map of reality than mine. So I can't understand it, but he is living his best life. And I think that Rockefeller, as an example, I would never want to trade lives with Rockefeller. But was he living his definition of enough? Maybe. Maybe his definition was going and creating this incredible thing, building something huge. It's like it's very much like the story of the fisherman and the investment banker. This investment banker goes down to a Mexican fishing village. He's on the docks, and he comes across this boat. And he says to the fisherman, how long did it take you to catch these few fish? The fisherman says, only a little while. And the banker says, why didn't you fish for longer? And the fisherman says, well, I have everything I need. In the morning, I fish for a little while. Then I go home, I have lunch with my wife. Then I take a nap. And in the evening, I go into town, drink wine, play music, and laugh with my friends. And the banker leans in and is like, you got this all wrong. Here's what you have to do. You have to fish for longer so you can catch more fish. Then you buy a second boat, then that boat catches fish. Then you buy a third boat, fourth boat, fifth boat, sixth boat. You move to the big city, you take your fishing enterprise public, and you make millions. And the fisherman says, and then what? And the banker says, and then what?
Then you can retire and move to a small fishing village. You can fish for a little while in the morning, and then in the afternoon you have lunch with your wife, take a nap, and then in the evening you can go into town, drink wine, play music, and laugh with your friends. And that story is traditionally interpreted to say that the banker is wrong and the fisherman is right. I completely disagree. I think it is about the fact that the two have a fundamentally different definition of what it means to have enough. The banker is much more Rockefeller-like. He might believe that having enough means building something big, creating jobs, creating this enormous enterprise. That is his purpose. That is his mental wealth. But the fisherman is already living his definition of enough. So for the banker to try to apply his map of reality to the fisherman's terrain makes no sense, and vice versa. That is what we do when we spend our lives on social media, feeling bad about the things that we have or the life that we're trying to build because of what someone else is doing out there. Someone else's life telling us that we are not living the right version of ours. And so that is the meta point of all of this. I said this at the beginning. We need to all ask the question of whether the mountains we are climbing are actually mountains that we care to be on. The races you're running, do you actually want to be running this race, or is there a different one? By questioning the defaults of all of these things and living by design in our own world.
It reminds me of be yourself because everybody else is already taken. So with that, Sahil, amazing. We've got the QR code up for your book. Everybody should go out and buy a copy. And if you have one with you, Sahil is going to be with us for a little bit at the cocktail, and he can sign your book. You can get a photo with him, and you can ask him more amazing questions. But we got to go. So please join us all in Luma. And I think everyone got 2 drink tickets. So
2 drink tickets, but I'm going to ask for a favor. There should also be a merch bag where you're sitting, somewhere around that range. There's a hat in that bag. We want to take a selfie with everyone here, if y'all don't mind. We're going to be up on stage. We want to throw the hat on, hold the hat up, do something fun with the hat, and let's have a good time. Let's do it. Oh, thanks so much, guys. Heck yeah, woo! Thanks so much.